like, share, and subscribe. Wishing you happiness and good luck every day.
Welcome to The Explainer. Today, we're going to break down an investment mindset that's truly stood the test of time. Look, this isn't about chasing hot stocks or trying to time the market to get rich quick. It's about something way more important. It's about building a financial fortress around your capital, allowing you to grow it, sure, but more importantly, making sure you don't suffer a catastrophic loss. The real goal isn't just to win, it's to guarantee you can stay in the game, period.
You know, Mark Twain just absolutely nailed it with this one. This quote cuts right to the bone of the biggest mistake that so many people make with their money. They confuse investing with speculating. Yeah, on the surface, they can look kind of similar, but trust me, they are two completely different games. They have different rules, they require different mindsets, and they lead to vastly different places. Getting this one distinction right from the jump, is everything.
So, let's ask that critical question. What game are you really playing? I mean, when you click that buy button on a stock, are you putting on your investor hat or your speculator hat? It's so important because the answer to that question dictates your entire strategy, how you handle your emotions, and, well, what your results are going to be. Most people never even stop to think about it, but today, we're going to tear them apart. And here is the fundamental difference in how you see the world. The investor, on the left, sees a stock for what it actually is, a tiny piece of a real business. You know, think of it like buying a small steak in your neighborhood pizzeria. Your whole focus is on how much the pizzeria is really worth. The speculator, on the other hand, sees that same stock as just a piece of paper, a poker chip. They couldn't care less if the pizzeria is profitable. All they're betting on is whether some other person will pay more for that chip tomorrow.
Yeah, that speculator's mindset leads you right into what's called the greater fool game. It's a dangerous game. You buy something not because you think it's worth the price, but because you're hoping, you're praying that you can find an even greater fool down the line to take it off your hands for more. It's basically a high-stakes game of hot potato, and the only goal is to not be the guy left holding the potato when the music stops. And believe me, it always stops.
And this is where it gets really dicey. See, the minute you start playing that speculator's game, you're not dealing in facts and business analysis anymore. You're in the business of guessing human psychology, trying to predict the whims of the crowd. And that just throws the door wide open for the two most destructive emotions in finance. The two emotions that bring down even the smartest people.
Let's just walk through this, because this cycle repeats over and over and over again. It all starts when some asset gets hot and the price just rockets up, completely untethered from its real value. You see it happening, that fear of missing out kicks in, and you jump in, ignoring the fundamentals. From that moment on, your success has nothing to do with the business. It is 100% dependent on finding that next person, that greater fool. And if that person never shows up, well, game over. You're it.
And at the core of it all, it's these two ancient emotions. Greed completely takes over when the market's flying high. You see your neighbors making what looks like free money, and that envy just eats at you until you dive in headfirst. Then, when the market does what it always does and turns, that greed flips like a switch into pure, gut-wrenching fear, and you panic sell, usually at the absolute worst possible moment. The real difference between the winners and losers in this game isn't IQ. It's having the discipline to master these two things.
So how in the world do you protect yourself from your own emotions? Well, the legendary investor Benjamin Graham came up with this brilliant mental tool. He said, stop thinking of the market as this all-knowing force. Instead, picture it as a person, a business partner named Mr. Market. Now, the thing about Mr. Market is that he's a manic depressive. Every single day, he shows up at your office, either screaming with joy or weeping in despair, and he offers to either buy your shares or sell you his at some wild price.
And here's the genius of it, the total psychological flip. You don't have to listen to him. He works for you. You don't work for him. So when Mr. Market shows up euphoric, totally irrational, offering to buy your assets for some ridiculously high price, you can calmly say, sure, I'll sell to you. And when he comes in panicked and depressed, offering to sell you his stuff for pennies on the dollar, you can calmly say, yes, I'll take that bargain off your hands. But the most powerful thing you can do is ignore him completely. You can just wait until his emotional state creates an opportunity for you. You use his craziness to your advantage instead of letting it infect you.
Okay, so we've got a handle on the internal battle, the one inside our own heads. Now let's look outside. Let's talk about the professionals, about Wall Street. We're always told to trust the experts, right? But it is so important to understand the game they're forced to play, and to ask the tough question, whose interests are they really looking out for?
This right here gets to the absolute heart of Wall Street's business model.
The entire system is built on activity, on motion. They make money on fees from buying and selling, they make money creating and marketing shiny new products, and they are under crushing pressure to avoid looking different from the crowd, because if they do, clients might leave. See how all of these things, the need to be busy, to follow the herd, to focus on the short term, are often the exact opposite of what a patient, smart investor should be doing?
This pressure creates something called the short-term relative performance derby. Just think about that. For most pros, the number one goal isn't to get the best possible return over the next decade. No, it's to not look worse than their competitors over the next 3 months. This incredible fear of short-term underperformance forces them all to huddle together in the same popular stocks and to avoid anything that seems unconventional, even if it's a brilliant idea.
So it can sound kind of bleak, right? We've got our own emotions trying to sabotage us, and we've got a professional industry playing a completely different game. But here's the good news. There is a powerful, disciplined, and frankly simple antidote to all this chaos. It's the beating heart of value investing, and it's called the margin of safety.
And it all begins right here, with this legendary mantra from Warren Buffett. Before you even think about how much money you could make, before you get excited about the upside, your first, second, and third thought, your obsession, has to be on not permanently losing your capital. Avoiding loss isn't just one part of the philosophy, it is the absolute foundation of the entire thing.
And if you want to know why Buffett is so fanatical about this, just look at the brutal, unforgiving math. A 10% loss? Okay, not great, but you only need an 11% gain to get back to even. Manageable. But look what happens as the losses get bigger. If you lose half your money, a 50% loss, you don't need a 50% gain to recover. You need to double what's left, 100% gain, just to get back to where you started. The math of compounding is a beautiful thing on the way up, but it is a monster on the way down. A good defense is everything.
So how do you avoid these awful losses? It's simple. You demand a margin of safety on every single thing you buy. This is the big idea. It's the gap between what you calculate a business is really worth, its intrinsic value, and the price you pay. That discount, that buffer between value and price, that is your protection. It's your cushion for when you make a mistake, or you just get unlucky, or Mr. Market has one of his wild mood swings.
And Buffett, of course, has the single best analogy for this. You never build a bridge that could only hold the exact weight of the trucks driving over it. That would be insane, right? No, you build it to hold 3 times the weight. That extra capacity, that's the margin of safety. It's the exact same principle in investing. You buy something for so much less than you think it's worth that even if you're a little bit wrong or something bad happens, you're still protected. And this whole mindset really stands on 3 pillars. First is the bottom-up approach. That just means you ignore all the noise about the economy and the direction of the market. You act like a detective, just looking for individual bargains, one at a time. Second, absolute performance. You're not in a race against the S&P 500. The only benchmark that matters is earning a safe and satisfying return for yourself. And third, risk aversion. You are obsessed with the downside. Before you ever ask, how much can I make, you always ask, how can I lose?
So you might be thinking, okay, this all makes sense, but how can I, one person, possibly compete with the giants on Wall Street? And here is the beautiful twist. Their biggest weaknesses are your greatest strengths. You don't compete with them. You play an entirely different game.
See, because these giant funds are so enormous and have so many rules, there are huge parts of the market where they simply can't invest. They're too big to buy a small company without moving the price. Their rules forbid them from touching complicated things like bankruptcies. And because of career risk, they can't go anywhere near an industry that's unpopular or out of favor. Well, guess what? Those neglected, messy, forgotten corners of the market are exactly where the best bargains live.
The great investor Seth Klarman, who literally wrote the book called Margin of Safety, he has this perfect metaphor for it. He calls the big Wall Street funds investment elephants. They're so huge they can only stop around after the biggest, most obvious opportunities. And as they do, they leave a trail of crumbs behind. For a smaller, quicker investor, those crumbs can be an absolute feast.
And that really brings us to the final beautiful paradox of this whole approach. The market's craziness, the volatility, the panics, the manias, all the emotional mistakes that other people make, those aren't the risks you should be afraid of. No, they are the source of your opportunity. It is precisely the fear and greed of the crowd that creates the ridiculous mispricings that allow a rational person to step in and buy a wonderful business with a margin of safety.
And so that leaves us with the one fundamental choice that every one of us has to make. The emotional tides of the market, the greed and the fear, they are not going away. They will always be there. The only question is,
Are you going to be a ship that's just tossed around by those waves, controlled by the panic and euphoria of the moment? Or are you going to be the lighthouse, standing firm, and using that very storm as a guide to find your way safely to shore? The answer to that question will determine everything. You know, in the world of finance, you can follow 1,000 different strategies. But when you boil it all down, they really come down to a single fundamental choice. It's a choice that, honestly, more than anything else, separates sustainable wealth from a quick flameout. So today, we're going to break down that critical distinction. Are you an investor or are you a speculator? Because the answer, well, it changes everything.
Mark Twain, as usual, just cuts right to the heart of it, doesn't he? He really understood the dangerous allure of speculation. That little whisper in your ear that promises easy money. It feels like a game you can actually win. But as we're about to see, it's a game where the house always has an edge, whether you're betting your very last dollar or a fortune you think you can afford to lose. So here's our game plan. First, we're going to define these two core mindsets. Then we'll dive into a classic story that just perfectly captures that speculative fever. After that, we'll contrast it with the solid logic of real investing, introduce a powerful mental tool to help you navigate the chaos, and finally, we'll talk about the biggest obstacle of all, our own emotions. It all leads up to the one choice that's going to define your financial journey.
All right, section 1. 2 ways to play. Look, whether you're a seasoned pro or you just opened your first brokerage account, you are playing one of 2 very, very different games. This has nothing to do with stocks versus bonds or tech versus healthcare. It's about something way deeper. It's your mindset. It's not about what you own, it's about the fundamental reason why you own it.
And this is really where the two paths split. The investor, they see a ticker symbol and they think, I'm buying a small piece of a real business with actual buildings and employees and customers. So their main question is, what is this business really worth? The speculator, on the other hand, sees that exact same ticker and thinks, I'm buying a lottery ticket in a popularity contest. Their only question is, will the price go up? That's it.
The investor's entire philosophy is anchored in reality. Their feet are planted firmly on the ground. They operate on this core belief that, over the long haul, a stock's price will eventually follow the real-world performance of the business itself. Its profits, its cash flow, its growth. So for them, an opportunity is born when the market's price gets temporarily disconnected from that tangible underlying value. The speculator, though, is living in a totally different world, completely detached from business fundamentals. It doesn't matter one bit if the company sells software or shoelaces. Their whole focus is on psychology, on trying to outguess what the crowd is going to do next. It's not about reading a balance sheet. It's about predicting herd behavior. Really, they're just playing a high-stakes game of chicken against everybody else.
Okay, section 2, the trading sardine game. To really, truly get inside the speculator's head, there's this fantastic old story that says it all. It's the tale of the trading sardines, and it just perfectly captures the absurdity at the very heart of pure speculation.
So the story goes that one year, the sardines just disappeared from the waters off Monterey, California. Poof, gone. With the real supply gone, this absolute frenzy erupts on the commodity exchanges. Traders start bidding up the price of the few remaining cans of sardines to just astronomical heights. A crazy market develops, with everyone buying and selling the same few cans back and forth, making paper fortunes along the way.
Then one night, a trader decides to celebrate his big win. He takes a can home for dinner, he cracks it open, and he immediately gets sick. He storms back to the guy who sold it to him, totally furious. "These sardines are rotten," he yells. The seller just shrugs and says, "You don't understand. These are not eating sardines, they are trading sardines." And boom, in that one line, the whole game is revealed. The value had absolutely nothing to do with what was actually in the can.
This is the perfect illustration of what we call the greater fool theory. It is the very soul of speculation. The whole strategy is to buy something that's overvalued, not because you think it's worth the price, but because you're betting that you can find an even greater fool to sell it to for more money. It's like a game of musical chairs, and the only problem is, sooner or later, the music always stops.
And hey, this isn't just some quaint old story. This game plays out all the time in the real world. Just think about the disk drive boom back in the early 80s. A dozen different manufacturers went public. And in the middle of all this incredible hype, their combined market value soared to an astonishing $5.4 billion. But just over a year later, the music stopped. The industry just couldn't support that level of speculative mania. The bubble burst and that valuation collapsed all the way down to just $1.5 billion, wiping out almost $4 billion of wealth. The people who bought at the top were left holding the bag. They found out they hadn't bought the future of technology, they had just bought some very expensive trading sardines.
Section 3. Buying a real business. Okay, so if that's the speculator's game of hot potato, how does a true investor actually make money? Well, it has nothing to do with finding a greater fool. It's all about owning a piece of a real, productive business.
For an investor, profit comes from 3 concrete, logical places. First, you get your slice of the actual cash the business generates. Simple enough. Second, as the business grows and becomes more successful, the market might be willing to value it more highly. And third, if you are smart enough to buy the business for less than it was actually worth, you profit as the market price eventually catches up to that reality.
And this brings us to what might be the most important distinction of all. A true investment generates value all by itself. A factory makes things, an apartment building collects rent. A speculation, though, whether it's a rare painting or a crypto coin with no real use, it produces nothing. Its only source of return is the hope that you can sell it to someone else for more. The value is totally circular. It's valuable simply because other people think it's valuable.
Number 4, meet Mr. Market. Now, choosing to be an investor is one thing, but how do you actually stay an investor when the market is going completely haywire all around you? How do you handle those wild, often irrational price swings? Well, thankfully, the legendary investor Benjamin Graham gave us the perfect mental tool for this. It's an allegory he called Mr. Market.
I mean, this is the challenge every single one of us faces, right? When prices are soaring up or crashing down, what do you see? Do you see it as a verdict on your decisions, like a real-time report card on how smart you are? Or do you see something else entirely?
Graham's story asks you to imagine that you're in business with a partner named Mr. Market. And this partner, well, to put it mildly, he's emotionally unstable. Some days he's euphoric, totally convinced your business is the greatest thing in the world, and he'll offer to buy your shares for some outrageous price. But other days he's gripped by despair, convinced the world is ending, and he'll offer to sell you his shares for pennies on the dollar. He's your manic-depressive partner.
Your job as the intelligent investor is to never, ever let Mr. Market be your guide. He is there to serve you, not to instruct you. Most of the time, you just ignore his daily mood swings. They're just noise. But, and this is key, on the rare occasions when his mood becomes truly extreme, either euphoric or terrified, that's when you act. You use his irrationality to your advantage, buying from him when he's panicked and selling to him when he's greedy. In this partnership, you have to be the sane one.
And that brings us to number 5, greed, fear, and you. This is the final and frankly the most difficult part of the whole equation. Because Mr. Market's real power isn't in his price quotes, it's in his ability to infect you with his emotions. At the end of the day, your success or failure as an investor won't be determined by the market, but by your ability to master the internal battle against your own greed and your own fear.
The difference between success and failure so often just comes down to this. It's not about having a higher IQ or some secret formula. Successful investors are simply the ones who have the emotional strength to stay rational when everybody else is losing their mind. They're disciplined enough to be cautious when the crowd is greedy, and they're brave enough to be resolute, maybe even opportunistic when the crowd is panicking. They simply refuse to let Mr. Market's mood become their own.
Greed is an investor's absolute worst enemy. It makes you impatient. It makes you chase shortcuts and hot tips. It whispers those 4 most expensive words in finance. This time it's different, convincing you to justify prices that are just absurd. Greed is what turns a disciplined investor into a gambler. And when that bubble inevitably pops, that greed instantly curdles into panicked fear, locking in the most devastating losses.
All right, Section 6, your defining choice. So we've walked through the theory, the 2 mindsets, the speculator's game, the investor's reality, and that internal battle. But now it's time to bring it all home. It all distills down to one single defining choice that you have to make with every single dollar you put into the market.
And so, in the end, it really does all come back to the sardines. Every single time you think about buying a stock, a bond, any asset, you have to ask yourself this one simple question. Are you buying this because you understand it, because you value the actual business and you want to own it for the long term? Are you buying an eating sardine? Or are you just buying a ticker symbol, a piece of paper, purely in the hope that someone else will buy it from you later at a higher price? A trading sardine. That single choice is everything.
Look, if you're an investor, you are in a relationship with Wall Street. There's just no way around it. And like any serious relationship, you really need to understand who you're dealing with. Because here's the hard truth. The system you're counting on for your retirement, for your kids' college fund, it doesn't always have your best interest at heart. In fact, a lot of the time, it's actually designed to work against you. So today, we're going to pull back that curtain and see exactly how the game is played. So here's our game plan. We're going to start with the big one, the central conflict of interest that's at the heart of everything. Then we'll follow the money and see how commissions create all the wrong incentives. We're going to look at why the deck is so often stacked against you with new products and decode how financial innovation is often just a fancy way to create new fees. We'll also unpack the system's relentless bias towards optimism, and then we'll wrap up by giving you the single most powerful tool you have to protect yourself. All right, let's cut right to the chase. The entire problem really boils down to one simple thing: a total misalignment of goals. What Wall Street needs to do to thrive isn't always, and often isn't, what you need for your investments to thrive. It's as simple and as powerful as that. This right here, if you remember one thing from our time together, make it this quote. This is the Rosetta Stone for understanding the whole system. Now, this isn't about making Wall Street out to be some kind of evil empire. It's just about recognizing the rules of the game they're playing. Their goal is constant activity, transactions, deals, moving products, because that's how they generate fees. Your goal? Long-term, profitable growth. And a lot of the time, those two goals just don't line up. And you can see this conflict pop up in everything they do. I mean, just look at their three main jobs. When they're trading, they're supposed to be your agent. As investment bankers, they're creating and selling new stuff. And as merchant bankers, they're investing their own money. As we're about to see, every single one of these roles is loaded with potential conflicts. And here's the kicker. It's not a bug in the system. It's a feature. So where does this all start? Well, you just have to follow the money. It begins with the most basic thing of all: how people get paid. The entire compensation structure on Wall Street is built to reward activity, not necessarily good results for you, their client. I mean, this slide just lays it out perfectly, doesn't it? Wall Street is motivated by the transaction. They get paid their fee, their commission, the second you buy or sell. End of story. Whether that trade makes you a fortune or costs you a fortune down the line, well, that's kind of your problem. But your motivation is the complete opposite. It's all about the long-term result. This immediately creates a huge bias toward just doing something, anything to generate a fee, rather than the patient work of doing the right thing for your money. And this isn't just some abstract theory. This motivation gap has very real consequences. It means your broker might be nudging you toward a mutual fund that pays them a fat commission, even when there's a better, cheaper one available. It's what leads to churning, where your account is traded way too often just to rack up fees. Sometimes the firm is literally taking the other side of your trade, betting against you. And when they get into merchant banking, forget it. They're now your direct competitor. So the next time your broker calls with a hot idea, you just have to wonder, whose best interest are they really thinking about? All right, next up, let's talk about underwriting. The whole process of bringing a new stock to market in an IPO. This is where, as an individual investor, it can feel like the game is completely rigged against you right from the jump. This chart pretty much says it all. Your broker can make 100, maybe even 1,000 times more money selling you a piece of a brand new IPO compared to just executing a simple trade for you on an existing stock. We're talking a potential 8% commission versus, a few cents a share? So when you see that kind of incentive, which product do you think is going to get the hard sell? It's just human nature. Which leads to this very blunt but very important question. Before you ever buy a new issue, you have to ask yourself, how can I possibly win this game? Think about it. On one side of the table, you have the company's insiders, who know everything there is to know about the business. And on the other side, you have the underwriter who's been working on this deal for months. They control the price, the timing, who gets the shares. They hold all the cards. The deck is well and truly stacked. And here's a perfect real-world example of that stacked deck. On a lot of new closed-end funds, the underwriting team takes a commission of about 8% right off the top. So let that sink in. For every $10 you invest, only $9.20 actually gets put to work for you. You are starting the race already in an 8% hole. And this slide tells a story that plays out over and over again on Wall Street. Step 1, there's a ton of hype, and a new fund gets sold to the public at $10 a share. Step 2, almost immediately, the price drops below its real value of $9.20 because that 8% commission is gone. Step 3, the fund just sits there for months, maybe years, trading at a discount. And finally, step 4, some savvy activist investors see a bargain, they swoop in, buy up all the cheap shares, and then force the fund to liquidate so they can cash out at the full value. So let's tally the score. The underwriters win, the activists win, and who loses? the regular folks who bought in at the beginning. Now, this constant push to sell new things leads us to one of Wall Street's absolute favorite words, innovation. But whenever you hear that word, you need to pause and ask yourself a really critical question. Who is this innovation actually for? Because a lot of the time, complexity isn't a bug, it's a feature. It's a way to create brand new products that can generate brand new fees. Okay, check out this example from the mortgage world. A while back, investment bankers had a brilliant idea. They took something pretty simple, a big pool of mortgages, and they figured out they could slice it into different pieces. The first piece they called an IO, for interest only. It's literally just the stream of all the future interest payments from those home loans. And of course, the other piece of the puzzle was the PO, for principal only. You guessed it, this is just the stream of all the principal repayments from that same pool of mortgages. So, boom! They took one simple, understandable thing and magically turned it into two much more complicated things. And here is where that complexity gets really, really dangerous if you're not paying attention. Now, we all know that when interest rates go up, the value of a normal bond goes down. And that's what happens with the IO. But get this, when rates go up, the value of the IO actually rises. I mean, that's completely backwards, right? It's totally counterintuitive. The reason is, when rates are high, fewer people refinance their mortgages, so that stream of interest payments lasts longer than expected. It's a very tricky product designed to trip up the unwary. This quote just nails the whole problem. It's like Humpty Dumpty. It's way easier to break something apart than it is to put it back together. Wall Street makes its money on the slicing and dicing. But the huge risk for you, the person holding the pieces, is that the IO and the PO might not add up to what the original mortgage was worth. The whole can very easily become worth less than the sum of its parts. All right, let's switch gears and talk about the overall mood of the market. There's this powerful, almost invisible force at work all the time on Wall Street, a deep structural bias toward being bullish. The whole system is just geared to favor optimism because, let's be honest, optimism is better for business. And you don't have to look very far to see this bias in action. Just look at the research that comes out of the big firms. It's an absolute ocean of buy recommendations, a decent number of holds, and then this tiny, tiny little sliver of sells. And the reason is simple. A buy rating generates business from everyone. A sell rating, well, that only appeals to people who already own the stock. Plus, no analyst in their right mind wants to make an enemy of a company's management team who might be a huge investment banking client someday. Sell is basically a four-letter word. And it's not just the analysts. The entire ecosystem wants the market to go up. Think about it. The firms make more money. The brokers make more money. Corporate executives watch their stock options go to the moon. Even the government prefers a rising market because it makes the economy look good. It's this massive, powerful club where pretty much everyone has a vested interest in keeping the party going. This is pretty incredible. This bullish bias is literally baked into the rules of the market. You might remember that after the crash of '87, they put in these things called circuit breakers. If the Dow drops too fast, they just halt trading for a while to let everyone cool off. But notice what's missing. There's nothing like that on the upside. There's no rule to stop the market when it's going parabolic in some crazy speculative bubble. The rules are there to stop a panic, but not to stop a mania. And all this bullishness is basically the rocket fuel for every investment fad and bubble we've ever seen. The pattern is always the same. Some real, genuine trend starts, Wall Street smells the money, and rushes in to create products to sell to the public. Enthusiasm goes off the charts, prices get totally disconnected from reality, and then, eventually, the supply of new stuff just overwhelms the demand. And we all know what comes next, the bust. The problem is, Wall Street already got paid on the way up. It's the individual investors who are left holding the bag. So after hearing all of this, it would be pretty easy to think, wow, Wall Street is just a casino, and I should stay as far away as possible. But that is absolutely not the takeaway here. You can succeed. The key is to just go in with your eyes wide open, to understand the system for what it is, to realize that your single greatest asset as an investor isn't a hot tip from your broker. It's a healthy, well-informed dose of skepticism. Knowing about all these conflicts and biases isn't a reason to run away from the market. It's a reason to engage with it in a much smarter way. It means you can start playing the game on your own terms. When you understand Wall Street's short-term, fee-driven game, you can focus on protecting your own long-term goals. So, the real question isn't about their game anymore. It's about yours. Now that you know the rules they play by, how are you going to play?
Have you ever thought about this?
We've got trillions of dollars managed by literally the smartest people on the planet, and yet somehow the system they've built often fails the very person it's supposed to serve, the client. It's a massive paradox. Well, today we're going to pull back the curtain on what's called the institutional performance derby and figure out why this high-stakes game is, from the ground up, fundamentally flawed.
All right, so here's our game plan. First, we're going to get a handle on just how big this whole thing is, the sheer scale of it. Then, we'll zero in on the single biggest mistake. They're all chasing the wrong target. From there, we'll see why the system is basically built to fail, how that led to something called mindless investing. And, this is the best part, we'll see how knowing all this actually gives you a massive advantage.
You know, to really understand this paradox, you have to start with one simple, undeniable fact. Today's financial markets, they aren't driven by people like you and me. Not anymore. They are absolutely dominated by a handful of giant institutional players. And the scale is just, well, it's almost impossible to wrap your head around. Just look at this growth. It's explosive. Right after World War II, you had this boom in retirement funds, and that created a feeding frenzy for professional money managers. The amount of money they controlled went from something like $100 billion in 1950 to an absolutely staggering $6 trillion by 1990. I mean, this wasn't just a little bump. It was a revolution that completely changed who calls the shots in the market. So you fast forward to today, and these institutions are responsible for about 3/4 of all trading volume. Now, here's why that should matter to you. Their behavior, their weird rules, and all their flaws, they directly impact the price of every single stock you might ever own. So you see, understanding their game isn't just a nice to have anymore. It's absolutely essential if you want a chance to succeed.
Okay, so they're huge. We get it. But what game are they actually playing? Well, the rules of their game are dictated by one central and, believe me, deeply flawed concept: relative performance. And this right here, this is the rotten core of the whole problem.
So what in the world does that actually mean? Well, instead of asking a simple question like, did I make a good, solid, long-term return on this investment, the question becomes, did I beat the S&P 500 this quarter? Or did I do better than that guy down the street? You see, the goalpost is always moving, and it's not set by real value, it's set by what the rest of the herd is doing.
And this comparison, it's everything. On one side, you have the institutional goal, which is really just this frantic, short-term race where the main objective is just, don't come in last place. But on the other side, you have what you, the actual investor, want: good, steady, long-term growth. These two goals, they're not just different. They are fundamentally at war with each other.
It's one thing to talk about this as a concept, right? But what does it actually create in the real world? How does all this pressure really show up in the day-to-day decisions of managers who are juggling billions and billions of dollars?
Like dogs chasing their own tails. I mean, what a perfect image. It's frantic, it's exhausting, and when you get right down to it, it's completely pointless. Can you imagine getting a report card on your performance, not just every quarter, but every day, maybe even every hour, constantly comparing you to all your peers? How could anyone possibly keep a long-term view when the fear of getting fired for one bad quarter is always hanging over your head?
All right, so if this whole derby is so irrational, so counterproductive, then why does it continue? Well, the answer is buried deep in the very structure of the money management business. It's a system with incentives that are totally misaligned, and it actively, powerfully encourages groupthink.
Let's just walk through this manager's dilemma step by step. First, what's their real goal? Well, managers get paid a percentage of the assets they control, not for the results they produce. So their personal goal isn't to get you high returns, it's to gather more assets. So what's the method? What's the best way to not lose assets? Easy. Avoid looking bad in the short term, so you don't get fired. And the result? You get this massive herd behavior. Why would you ever take a bold, unconventional bet that could pay off big, when the career risk of being wrong and alone is catastrophic? No, the safe bet is to just hide in the middle of the pack. And this leads to the final consequence for you, a client. You get mediocre, totally uninspired performance.
And there's this huge psychological factor that just makes everything worse. Very few of these managers have a meaningful amount of their own money on the line. And that complete detachment, it changes everything. Believe me, it is really easy to take mediocre risks when you are playing with other people's money.
You know, this old story about the Roman arch, it perfectly illustrates the power of having skin in the game. That engineer's concern for quality was intensely personal, because his life was on the line.
When a fund manager's own wealth is directly tied to their investment results, not just their ability to gather more assets, the entire focus shifts. It stops being a game of relative performance and becomes a mission for absolute, real-world returns.
And the pressure doesn't stop there. The system itself adds even more roadblocks to success. I mean, think about it. Managers spend more time marketing themselves than they do on deep research. Big decisions get watered down by committees, which absolutely kills any bold or contrarian ideas. And underneath it all, they're still human, right? They're wrestling with the exact same greed and fear as everybody else. It is a perfect recipe for mediocrity.
So in response to all of these problems and just how hard it is to outperform, the industry came up with what seemed like a really logical solution. If you can't beat the market, why not just become the market? And this is what led to the explosive growth of indexing, or what you might call mindless investing.
And you can totally see the appeal, right? I mean, the logic on the surface seems flawless. You are guaranteed to match the market's performance. You will never be the one manager who gets fired for underperforming. Plus, it's incredibly cheap. For a committee that's managing a huge pension fund, this feels like the ultimate safe, prudent choice. But, and this is a huge but, here's the danger. When a massive and still growing chunk of the market just stops thinking, when it stops analyzing companies and just blindly buys stocks because they're in an index, it begins to warp the very fabric of how a market is supposed to work. And the side effects are just bizarre. First, the market gets dumber. It becomes less efficient because you have fewer people doing the hard work of figuring out what a company is actually worth. Second, prices get totally distorted. A stock gets added to the S&P 500, and suddenly billions of dollars are forced to buy it, which inflates its price for no fundamental reason at all. And maybe the most critical problem? You have these massive, passive owners who have zero incentive to hold corporate management accountable. Their only job is to track the index, not to make the companies they own any better.
And this chart really shows you why the trend is just so powerful. In the 31 quarters leading up to the source material for this explainer, the S&P 500 beat the average equity fund in 24 of them. So this creates this crazy self-reinforcing loop. Active managers underperform, so more money flows to index funds, which then boosts the performance of the big stocks in the index, which in turn makes active managers look even worse. It just feeds on itself.
And Warren Buffett, of course, just nails the consequence of all this perfectly. With the rise of indexing, a huge portion of your competition has basically been trained to believe that it is useless to even try. They've effectively given up on the search for real value. And for anyone who's still willing to do the hard work, well, that creates an incredible opportunity.
So this brings us to the final and I think the most important point. After looking at all these flaws and all this dysfunction, it's pretty easy to feel pessimistic. But the reality is, simply understanding how this broken system works is your single greatest advantage as an investor.
So, here it is. This is the crucial takeaway for you. All of those institutional handcuffs, the pressure to avoid a bad quarter, the obsession with only the biggest companies, the forced buying and selling, none of them apply to you. Their rules create pricing mistakes. Their blind spots are the exact places where you can go and find hidden value.
Think of it this way. The giant institutional elephants, they're all forced to graze in one crowded, overpicked field of large-cap stocks. They literally can't look anywhere else. And that means they leave behind countless opportunities, the crumbs, in smaller companies, in weird or complex situations, or in unloved sectors that they are structurally forbidden from ever touching.
So, the final question is really for you. Now that you understand the strange rules of their game, now that you can see the narrow, crowded path these elephants are forced to walk, where are you going to start looking? Because the places they are forced to ignore are precisely where independent thinking finds its greatest rewards. Thanks for watching.
All right, today we're going to dive into a story from Wall Street that honestly feels more like a Hollywood thriller than a finance case study. It's a tale about a truly radical idea that completely reshaped American business, poured fuel on a decade of insane excess, and then, as you might guess, came crashing down in the most spectacular way possible. This is the story of the junk bond and the incredible delusion that built a multi-hundred-billion-dollar empire on what was, let's be honest, financial sand. To really wrap your head around the scale of what happened, just look at this number, $200 billion. In the early 1980s, the market for what they politely called high-yield bonds was practically non-existent, a tiny little niche. By the end of the decade, it was a $200 billion behemoth. I mean, this wasn't just growth, it was a financial supernova, a complete explosion of capital that redrew the entire map of the financial world. And that really brings us to the core mystery we're going to unravel today. How on earth did this happen? How did a whole generation of really smart, sophisticated people, investors, bankers, you name it, get convinced to pour billions upon billions of dollars into bonds that were, by their very definition, junk? What were the powerful delusions, the clever tricks that made it all seem not just possible, but like a sure thing? Okay, here's how we're going to tackle this. First, we'll look at the man behind it all and the core idea that got, let's say, a little twisted. Then we'll dig into the financial machinery they built to hide all the risk. After that, we'll see the marketing genius that sold this thing like it was a moral crusade. Then, the flawed math they used to justify the insane prices. And finally, the spectacular, inevitable collapse. Right at the center of this entire storm was one guy, Michael Milken. Working out of his famous X-shaped desk in Beverly Hills, he basically took this obscure academic idea and put it on steroids. He built a machine that would churn out junk bonds and completely change the face of corporate America. But it all started with a brilliant and, as it turns out, incredibly dangerous leap of logic. So the original idea was actually pretty solid. It was based on something called fallen angels. Now think of it like this. You've got a great blue chip company that hits a rough patch. Investors get spooked, they dump its bonds, and the price just tanks. Well, some academics noticed that if you bought a whole basket of these bonds for, say, 50 cents on the dollar, you had this huge cushion, a margin of safety. The companies that recovered would give you massive returns, way more than enough to cover the ones that went belly up. It was classic value investing, right? Buy something good when it's cheap and everyone else hates it. But, and this is the whole game, right here. This is the crucial twist that the entire $200 billion market was built on. Milken started arguing that newly issued junk bonds, sold at 100 cents on the dollar, were just as safe. Now this is a completely different animal. With a fallen angel you bought cheap, your upside was huge. With a new junk bond sold at full price, your absolute best case scenario is you get your money back plus interest. But your downside? You could lose everything. He basically took a strategy based on buying cheap and used it to justify buying something risky at full price. It was the fatal flaw, hiding right there in plain sight. So you're probably wondering if the core idea was that shaky, how in the world did they sell so much of this stuff? Well, they had to create an illusion of safety. They had to make these incredibly risky bonds look safe, at least for a few years. And to do that, they developed a whole playbook of financial tricks designed to kick the can down the road and keep the money pouring in. It was really a three-part magic trick. First, when they structured these deals, they'd raise way more cash than the company actually needed. This created a little slush fund to make the first few interest payments, making the company look healthy right out of the gate. Second, and this was just pure genius, they invented bonds that didn't even pay cash interest. They were called zero coupon or PIKE for pay-in-kind bonds. It's like your boss saying, hey, I can't pay you in cash this year, but here's an IOU for an even bigger salary next year. The company's debt just kept piling up, but on paper, it looked like they never missed a payment. And third, Milken famously promised that his firm would always make a market, always buy any bond someone wanted to sell. This created this powerful illusion of a deep liquid market, when in reality, it was all being managed by one firm. Warren Buffett, with his usual knock for cutting through the nonsense, just nailed the absurdity of it all with this quote. He was basically saying, of course it's easy to have a perfect payment record if you never actually have to pay anyone any cash. These accounting tricks were making really sick companies look like Olympic athletes, but it was just a temporary fix. The underlying disease was still there, and it was just getting worse. Okay, so let's move on, because this wasn't just about spreadsheets and bond math. To get to $200 billion, you need more than just a financial product. You need a powerful story. And Milken and his followers sold the junk bond revolution with the passion of a moral crusade. They wrapped it in a narrative that was almost impossible to argue with. And the sales pitch was just brilliant because it had two sides. To the public, to Congress, they pitched junk bonds as the savior of small entrepreneurial companies, the engine of American job growth that was being shut out by stuffy old banks. It was democratic capitalism, capital for the little guy. But at the very same time, to corporate raiders and takeover artists, they pitched junk bonds as the ultimate weapon to go after lazy, inefficient Fortune 500 giants. So it was both a tool for building up and a tool for tearing down. It was for the little guy and the big shark all at once. So who was buying this story? Well, everybody. You had regular people, everyday investors, pouring their life savings into these new high-yield mutual funds, chasing double-digit returns they couldn't get anywhere else. Then you had the savings and loans, or thrifts. They had just been deregulated and were basically allowed to gamble with government-insured money. It was a classic heads I win, tails the taxpayer loses kind of bet. And finally, you had these massive insurance companies that were desperate to earn high yields to pay for promises they'd made years earlier. All of them were starving for returns, making them the perfect eager audience for Milken's gospel. Right, so you've got all this new debt being used to buy companies at higher and crazier prices. By any traditional way of valuing a business, these deals made absolutely no sense. The numbers just didn't add up. So if the old rules say your deal is nuts, what do? You don't walk away from the deal. No, you invent a new rule. And that new rule was a metric you've probably heard of, EBITDA. Sounds fancy, but the idea they sold was simple. It was supposed to be a pure measure of a company's raw, cash-generating power. It conveniently ignored things like taxes and, this is the big one, depreciation, which is the very real cost of your factories and equipment wearing out. The result was a number that was almost always bigger and looked way better than actual profit. And it became the new gospel on Wall Street. But this simple table just perfectly illustrates the deception at the heart of it. Take a look. You've got two companies. Company X is, say, a consulting firm. It has no real equipment, and it generates $20 million in real, actual pre-tax profit. Company Y is a heavy manufacturer. It makes zero profit, but it has $20 million in depreciation because its factories are old and falling apart. According to the new math of the 80s, these two companies have the exact same EBITDA, $20 million.
So are they equally good businesses? Are they equally valuable? Not even close. Company X can take its $20 million and pay down debt or give it back to its owners. Company Y has to spend every single penny of that $20 million just to replace its old, worn-out equipment so it can open for business next year. It has zero actual cash left over. But EBITDA made them look like identical twins, and it gave everyone the cover they needed to lend billions of dollars to deeply flawed businesses.
And there were other gimmicks, too, little financial placebos designed to make investors feel safe. A big one was the interest rate reset. The company would promise that if the bond's price ever fell, they'd just jack up the interest rate to push the price back up. It sounded like a money-back guarantee, but it was pure illusion. I mean, think about it. If a company is clearly going bankrupt, is there any interest rate high enough that would make you want to lend it money? Of course not. The promise was only good when you didn't need it. And so, the whole stage was set. You had a market that was built on a flawed academic idea, kept alive with accounting tricks, sold to the public with this almost religious fervor, and justified by a dangerously misleading metric. This wasn't a normal financial market. It was a house of cards, built right on a fault line, just waiting for the first tremor. By the late 80s, the whole thing was in a frenzy. The deals got bigger, more leveraged, more reckless. By 1988, the situation had become completely absurd. The average company issuing new junk bonds was actually earning less in cash flow than it owed in interest payments. The only way it could survive was by issuing even more junk bonds to pay the interest on the old ones. And then, in 1990, the music stopped. The new issuance pipeline just slammed shut, and the whole fraudulent math came crashing down. Defaults didn't just rise, they went ballistic.
And what about that promise of liquidity for Michael Milken? It just evaporated. The market completely seized up. This quote just captures the pure terror of that moment perfectly. The market became a roach motel. Trillions of dollars in paper value were just trapped. People who thought they owned a safe, liquid investment suddenly realized they owned something they couldn't sell at any price. The fallout was just this massive, brutal transfer of wealth. The people holding the junk bonds, the mutual funds, the insurers, and especially those savings and loans, they got wiped out. The shareholders of the companies that were taken over, the ones who got bought out at those inflated prices with all that junk bond money, they walked away with huge tax-free profits. And when hundreds of S&Ls went bankrupt from their junk bond losses, well, the U.S. taxpayer got handed the bill for a multi-hundred-billion-dollar bailout. And you know, this wasn't just some contained explosion in a corner of the market. The junk bond boom distorted everything. All that borrowed money sloshing around the system pushed up the prices of all stocks, not just the takeover targets. It created a dangerous, market-wide bubble. But more than that, it taught us all a painful, timeless lesson. Financial fads, no matter how clever they sound, can be absolutely devastating.
And maybe the real secret to long-term success isn't about finding the next big thing, but simply about avoiding the one catastrophic mistake. And that kind of leaves us with one final thought to chew on. The language changes, right? The securities get more complex, the players all get new names. But the underlying human psychology, the greed, that fear of missing out, the deep-seated willingness to believe a story that's just a little too good to be true, that part never changes. This delusion of value is a recurring character in financial history. So the real question isn't whether it's going to happen again, it's just what's it going to look like next time. All right, let's talk about what it really means to be a successful investor. It's not about chasing the hot new thing or trying to perfectly time the market. It's about a single fundamental rule that's so simple, you know what? It's almost always ignored. And we're going to dive into why that might be the biggest mistake an investor can possibly make. You've probably heard this quote from Warren Buffett before. It's the bedrock for our entire conversation today. Don't lose money. I mean, it sounds almost obvious, right? Maybe a little too simple. But trust me, hidden inside that very simple phrase is a really profound and powerful way to think about investing. And that brings us to the big question, doesn't it? If the most successful investor of our time has two rules, and they're basically the same rule just said twice, why does the behavior of most people in the market look like the exact opposite? That's the puzzle we're here to unpack. Okay, so here's our game plan. First, we're going to figure out what that rule really means. Then we'll challenge some of those common market myths you always hear. We'll look at the incredible math behind compounding, shift our focus from targeting returns to targeting risk, and finally, we'll wrap it all up with what it means to have a truly prudent investor's mindset. So let's start at the top. The first rule of investing. What does Buffett actually mean when he says, don't lose money? Because it's not quite as black and white as you might think. The first thing you gotta get is the time frame. This isn't about panicking over a bad day or a down quarter. Not at all. It means that your core strategy over the long haul should be all about protecting your initial capital, your principal, from a significant permanent hit. The goal here isn't to be perfect. The goal is to be resilient. And this gets right to the heart of why this is so hard. It feels like we're just hardwired to chase gains. You see a stock that's just going to the moon, everyone's talking about it, and that fear of missing out, man, it can be overwhelming. That urge to speculate is what makes it so incredibly tough to stay disciplined and just focus on protecting what you've already built. Which leads us right into our next section. We have to take on some of the market's most common sayings, some of its conventional wisdom, because a lot of these ideas actively work against that first rule. So on one hand, you always hear these market mantras, right? High risk, high reward, or the real risk is being out of the market. But the reality, when you focus on not losing, it flips that whole script. It says the surest way to profit long-term isn't chasing huge wins, it's just avoiding a major disaster. And this is key. Risk isn't just some vague concept. It's determined by the price you pay. This point right here is so important. You can have the best company in the entire world, innovative, profitable, incredible leadership, the whole shebang. But if you and everybody else pays way too much for its stock, it can become a terrible, risky investment. It's a crucial distinction to make. The quality of the company and the risk of the investment are two totally different things. Let's just make this personal for a second. Forget the stock market. Would you take this bet? Would you risk losing 30% of everything you own for a chance to gain 30%? Most people would say no way. The pain of losing that much would be so much worse than the joy of winning. Well, that feeling in your gut right there, that's risk aversion. And if that's how you feel, then avoiding loss has to be the cornerstone of your entire investment philosophy. Now look, this isn't just about feelings or philosophy. There is some cold, hard, inescapable math that proves why avoiding loss is so critical. And this is where the argument really becomes undeniable. If you only take away one thing from all of this, let it be this. The power of compounding over time is absolutely staggering. But, and this is the really important part, it's like a fragile magic trick. One single large loss can completely shatter years or even decades of patient progress. Let's just look at the power of patience right here in this table. Say you start with $1,000. Follow that 10% return column down. After 10 years, that $1,000 turns into about $2,600. That's solid. But now look what happens if you just let it run for 30 years. It grows to over $17,000. The real magic isn't some spectacular return. It's the uninterrupted time that lets that compounding do its thing. And to really hammer this point home, let's look at a tale of two different investors. This little scenario perfectly illustrates the absolutely devastating cost of having just one bad year. Okay, so check out the results of this race. Investor A, let's call her the tortoise. She just plods along, earning a consistent 16% every single year. Now, Investor B, the hare, he's a superstar. He's crushing it with 20% returns for 9 straight years. But in that last year, wham, he gets hit with a 15% loss. And as you can see, who ends up ahead? It's the slow and steady tortoise. That one single loss for the hare completely wiped out nearly a decade of outperformance. It's crazy. So if the math is so clear, why do even the professionals so often act like Investor B? Well, because for 9 of those 10 years, Investor B looks like an absolute genius. They're outperforming everybody, their clients are thrilled, business is booming. That psychic income, just the feeling of winning, it's a powerful and seductive force, even if it leads you to a worse outcome in the long run. This all leads us to a really fundamental shift in how we should be thinking about our goals. The way most people do it is actually a trap. We need a better target. This right here is the trap. It's so common. It starts with somebody just picking a number out of thin air. I need to make 15% a year. Then you have to build this whole optimistic story to justify it, which almost always means you end up taking on more and more risk that you haven't even measured. And when that optimistic story inevitably hits a bump in the road, you're the one left exposed to that catastrophic loss we keep talking about. The alternative is to just flip the whole process around. Don't target a return. Target a risk level. This forces you to focus on the downside first, and it's driven by disciplined analysis, not by desire. The whole question shifts from, how much can I make, to the much more powerful question, how much could I realistically lose here, and is the potential upside really worth that risk? All right, let's move to our final section and see how this all comes together. Because ultimately, avoiding loss isn't just a strategy, it's a complete mindset for how to navigate a future that is, by its very nature, completely unknowable. This metaphor is just brilliant. Think about it. A major flood might only happen once in 100 years, but you still buy flood insurance on your house every single year. Financial catastrophes, depressions, market crashes, they might be rare, but a prudent person doesn't just ignore them because they're unlikely. You prepare for them, because the consequences are absolutely devastating if you're wrong. So let's just be crystal clear about what this means. It's about being humble and accepting that you can't predict the future. The goal is to build a portfolio that can survive whatever the world decides to throw at it. Now, this might mean accepting slightly lower returns in the good years. Think of that as your insurance premium. And this is not about hiding in cash or gold. It's about being actively prepared for any storm that comes your way. And if you're sitting there wondering if there's a formal name for this whole philosophy we've been talking about, well, there is. It's the core principle behind an approach called value investing. It's a discipline built from the ground up to systematically focus on buying assets for less than they are actually worth, which creates a built-in margin of safety against that unpredictable future. So we'll end with this one question for you to really think about. Take a good hard look at your own strategy. Is your portfolio built to win? Or is it built, first and foremost, not to lose? Because at the end of the day, those are two very, very different things, and the answer could make all the difference in the world. Today, we're going to dig into the single most important principle in all of value investing. Now, it's a concept so simple you can say it in one sentence, but it's so challenging to put into practice that very few people ever really get it right. I mean, look at that. It doesn't get much simpler, does it? That one line pretty much captures the entire philosophy. This isn't about gazing into a crystal ball or trying to catch the next rocket ship stock. No, it's all about a disciplined, almost relentless hunt for a bargain. So how do we actually do that? How do we go from that simple idea to a real workable strategy? Well, here's how we're going to break it down. We'll start with the mindset, then we'll talk about the almost superhuman patience it requires. After that, we get to the main event, the margin of safety. And then we'll look at why this whole thing works in the real world and what it really takes to pull it off. Okay, let's dive in. First things first, value investing is not about some secret, complex math formula. It's a way of thinking. It's a mindset that's completely built on discipline. The whole thing really comes down to 3 key parts. 1, you have to do your homework and figure out, conservatively, what a business is actually worth. 2, you need the discipline to just wait. and wait until the price drops to a point where it's a true bargain. And 3, you hold on. You're patient until the rest of the market finally catches on to the value you saw all along. That discount, that bargain, it isn't just a part of the strategy, it's the entire point.
And you know, this right here, this is the hard part. The math isn't the tough bit. The discipline is. Being a true value investor means you're almost always a contrarian. You're buying when everyone else is panicking and selling. You're ignoring the hot stocks everyone is raving about. It can be a really lonely path. And I'll tell you what, you might even look kind of foolish for a while, especially when the market is just going straight up. But in the long run, this is where the whole philosophy proves its worth. To really get a handle on the kind of patience we're talking about, Warren Buffett gives us this perfect analogy from baseball. Okay, so picture this. You're standing at home plate, but in this game, there are no called strikes. You could literally stand there all day, let 100 pitches whiz by, and there's no penalty. That is the value investor. They don't feel any pressure from the crowd or a boss to be constantly swinging, to always be in the game. They can just wait and wait for that one single perfect pitch right in their wheelhouse. Meanwhile, your typical institutional investor, they feel like they have to swing at everything. And that, my friends, is a recipe for mediocrity if you're lucky. So what does that perfect pitch even look like? Well, it's not just one thing. It's a checklist of 4 crucial criteria. First, you have to actually understand the business. It can't be some black box. Second, it can't be wildly risky, which is why a lot of value folks tend to stay away from things where the future is just too hard to analyze. Third, it has to be a good absolute value. In other words, it's just plain cheap compared to what it's worth. And finally, and this is the killer, it has to be the single best bargain you can find right now. It's an incredible double discipline that makes it so tough. Okay, but this brings up a huge problem, right? The value of a business isn't set in stone. It's constantly moving around with inflation, interest rates, competition, you name it. So if your target is always shifting, how can you ever really know you're getting a good deal? How can you ever be sure that you're investing safely? Now, this question is the central challenge for any investor. And the solution, which came from the father of value investing himself, Benjamin Graham, is probably the single most important concept we're going to talk about today. It's what he called the margin of safety. Right. The key takeaway is this. You know you're not a fortune teller. You know the world is unpredictable. So you never, ever pay $1 for what you think is $1 of value. You demand a discount. That discount is your buffer. It's your protection against your own mistakes, against bad luck, against a future that none of us can predict. And remember this, the margin of safety is always, and I mean always, determined by the price you pay. This analogy is just brilliant. Buffett makes the whole idea crystal clear. You don't build a bridge that can just barely handle the weight of the trucks you expect to use it. No way. You over-engineer it. You build in a massive cushion for error, for bad weather, for things you can't even imagine going wrong. That extra strength, that cushion, that's your margin of safety when you invest. And this idea also explains why old-school value investors really like tangible assets. Just think about it for a second. If a company goes bust, you can still sell off its real estate, its inventory, its machines. Those things have a real, concrete value. But what if a company's main asset is its brand name, and suddenly people just don't like that brand anymore? Poof! The value can just evaporate overnight. The margin of safety is just so much lower. All right, so the theory is solid. It makes sense. But why do these discounts, these opportunities, even pop up in the first place? To get that, we need to understand how value investors see the stock market itself. You see, the entire philosophy of value investing is really a bet that the market is often inefficient. There's this academic theory, the efficient market hypothesis, that basically says it's impossible to find bargains because all the known information is already baked into the price. Now, value investors agree with a small part of that. They agree that just looking at charts of past prices is useless, but they completely reject the idea that the market is always rational and correct. And this classic quote from Graham and Dodd tells us why the market gets it wrong. Over the long haul, yeah, the market is like a weighing machine. It'll eventually figure out what a business is truly worth. But day to day, in the short run, it's a voting machine. It's a popularity contest driven by fear, greed, hype, and panic. And it's in those emotional swings that prices get disconnected from real value, and that's what creates the opportunity. Let's look at a classic real-world example. Back in 1987, the oil giant Texaco got hit with this huge $10 billion legal judgment and had to file for bankruptcy.
Well, you can imagine total panic set in. All these big institutions that weren't allowed to own bankrupt securities were forced to sell no matter the price. They just dumped their Texaco bonds. But if you did the math, a disciplined analysis showed that even in a worst-case scenario, Texaco's assets, its oil fields, its refineries, were worth more than enough to cover all its debts. That forced selling and that intense fear created a massive margin of safety. Investors who had the guts to buy those bonds when they were on sale could have made a return of over 25% a year, with very, very little real risk. The uncertainty is what created the bargain.
And this is really where the margin of safety shows its true power. When the market's going up, a rising tide lifts all ships, right? Everybody looks like a genius. But as Buffett says, you don't find out who's swimming naked until the tide goes out. When the market turns down, all those high-flying stocks that were bought on hype and hope get torpedoed. But the value investor who bought with a built-in cushion, they're protected. Their downside is limited because the price they paid already accounted for some bad news.
Now, here's a word of warning. Because this philosophy works so well over time, the label value gets slapped on everything. And it's absolutely critical that you can tell the difference between the real thing and the pretenders. These are the folks who talk the talk, but they don't walk the walk. They use value as a marketing slogan, but they don't have the conservative discipline. They'll use wildly optimistic projections to justify paying a high price for a stock. And sure, they look great when the market is booming, but when the tide goes out, like we just talked about, they're the ones left exposed. Real value investing is a conservative, risk-averse philosophy. It's not a brand. So let's pull all these threads together. What's the final takeaway here? What does it really take to put this powerful philosophy into action? When you boil it all down, it comes to these 3 personal traits. Believe it or not, the financial analysis is the easy part. The truly hard part is having the discipline to say no again and again and again. It's having the patience to sit on your hands, maybe for years, waiting for that fat pitch. And then it's having the judgment and the courage to step up and swing with conviction when it finally comes. And that's really the question you have to ask yourself. The principles are simple. Anyone can understand them, but the discipline to actually follow them is incredibly rare. It requires a temperament that frankly goes against most of our human instincts to follow the herd. So the final question isn't whether you get the concept. The question is, do you have the patience to wait for your pitch?
All right, let's get right into it. Today, we're going to dig down to the very roots of a truly powerful, time-tested investment philosophy. We're going to peel back the layers one by one to really understand the foundation and see what makes this whole thing tick.
So, let's start with a really important question you need to ask yourself. When it comes to your hard-earned money, are you trying to play what's called a greater genius game? You know, are you trying to outsmart literally everyone else, trying to predict a future that's, well, completely unknowable? Or is there another way, a more grounded, more rational path? How you answer that one question changes absolutely everything.
So here's the game plan for this explainer. We'll start with the 2 big paths every investor has to choose from. Then we'll look at the difference between trying to be a psychic and being a detective. After that, we'll talk about what it actually means to win, what risk really is, and finally, how it all comes together in a philosophy built on patience.
Okay, first up, the 2 investment paths. See, this isn't about a bunch of complicated spreadsheets or fancy algorithms. It's about a single, fundamental choice you make right at the start. It's a fork in the road, and the path you pick is going to define your entire journey.
And really, it all boils down to this. It's that simple. On one hand, you have the predictors, the forecasters, the people with the crystal balls. They're trying to guess, what's the economy going to do? Where are interest rates headed? Then you have the other camp. They're not looking at a crystal ball. They've got a magnifying glass. They are detectives, and their only job is to figure out what a business is worth, right here, right now.
So how does this choice actually play out in the real world? Well, that brings us to this core idea of top-down versus bottom-up investing. This is really the heart of it, the speculator versus the detective. You see this top-down approach everywhere, especially on financial news. It's always about the big picture. It starts with some grand prediction, electric vehicles are the future, or inflation is going to soar. And only after making that huge forecast do they try to find a stock to fit the story. The entire game is built on prediction.
And this is where you can really see how fragile that approach is. It's not one prediction, it's a whole chain of them. Think of it like dominoes. You have to get the big economic trend right. Then you have to guess which sector wins, then which industry in that sector. Then you got to pick the one right company. And oh yeah, you have to time your purchase perfectly.
If just one of those dominoes falls the wrong way, the whole strategy just collapses.
And this quote from the source material just nails it. To win the top-down game, you're in one of two situations. Either you're playing a greater genius game, meaning you genuinely know more than millions of other smart people, or you're playing a greater fool game, where you're just hoping that some other person, some greater fool, will come along and pay you more for your asset later. Neither of those sounds like a very reliable way to build your financial future, does it?
So what's the alternative? Well, it's the complete opposite. With the bottom-up approach, you basically put on noise-canceling headphones to block out all that big-picture chatter. You become a detective. You're not trying to predict the path of a hurricane. You're just carefully examining one house at a time, looking for value, looking for a bargain, security by security.
And if we put them side by side like this, man, it is night and day. The speculator is focused on predicting the future. The investor is focused on the value of a business today. The speculator's whole bet is that they are right about what's going to happen. The investor's bet is much simpler, that the price they're paying is less than what the thing is actually worth. It's the greater genius game versus a much calmer mindset. Buy a bargain and wait.
Okay, so that leads us right into the second big pillar of this philosophy. Because it's not just about how you pick things, it's about how you keep score. How do you even know if you're winning? Are you playing a relative game or an absolute one?
Think about two different runners. The relative performance runner is constantly looking over their shoulder. Their whole goal is to beat the other people in the race. They're always asking, am I beating the S&P 500 this year? The absolute performance runner, though, they're not even looking at the other racers. They're just focused on their own pace, on their own finish line. Their only question is, am I safely getting to my own financial goal?
And this all comes down to a really simple, powerful truth summed up in this quote. You can't spend relative performance. It feels good to tell your friends you beat the market, but if the market went down 30% and you only went down 29%, you still lost 29% of your money. You can't pay your mortgage with, I almost kept up. At the end of the day, the only thing that matters is the actual real money in your account.
And there's no better example of this difference than how the two approaches treat plain old cash. To the relative performer, cash is a boat anchor. It's dead weight. It creates drag when the market is going up, so they feel this constant pressure to be fully invested. But to the absolute performer, cash is one of their most powerful tools. It's a safety net when things go south, and it's dry powder, ammunition, ready to be deployed when everybody else is panicking and bargains are everywhere.
All right, this next piece of the puzzle is, well, it's probably the most important shift in mindset of them all. We have to completely deconstruct the idea of risk. Because how a value investor defines risk is fundamentally different from pretty much everyone else. We've all heard this a million times, right? It's taught in every business school. To get higher returns, you must take on more risk. It's presented like it's a law of physics. But a value investor looks at that and asks a very simple, very profound question. Really, is that always true? Or is it possible to find high returns with low risk? So to try and measure this risk, the academic world came up with this single number called beta. And what is beta? It's basically just a measure of how much a stock's price has wiggled around in the past compared to the market. That's it. If it wiggles a lot, it has a high beta, and therefore it's high risk. End of story.
And the response from a value investor to that idea is, well, pretty blunt. They find it, as this quote says, preposterous. And it makes sense when you think about it. How could one little number that only looks at past price wiggles possibly tell you everything you need to know about the risk of owning a piece of a real-life business? It just doesn't compute.
Here's exactly why beta is so misleading. It doesn't know a thing about the actual business, its debt, its managers, its competitive position, and most absurdly, it completely ignores the price you pay. Beta would tell you that buying a fantastic company for $100 is just as risky as buying that exact same company for $50. It's like trying to drive a car by looking only in the rearview mirror. It's a recipe for disaster.
So if beta is nonsense, what's the real definition of risk? Well, it's actually incredibly simple and just plain common sense. Risk is not a squiggly line on a chart. Risk is the chance that you will permanently lose your money. That's it. And that risk comes from two places: the quality of the business you're buying and the price you pay for it.
And this is where your whole perspective can flip upside down. For most people, when a stock price falls, they think, oh no, the risk is going up. But if you've done your homework and you know what a business is actually worth, a falling price means the risk is going down. The market going down isn't something to fear. It's an opportunity. It's your favorite store announcing a 50% off sale. You don't run away from that, you run towards it. So,
Let's tie all these threads together. When you take these three core ideas, being a bottom-up detective, focusing on your own absolute race, and defining risk rationally, what you end up with is a complete, powerful philosophy. And at its heart is one simple thing: patience.
And here it is, the value investor's creed, all on one shield. Number 1, you are a detective, not a forecaster. Number 2, you are running your own race toward your own finish line. And number 3, your first job, above all else, is to avoid permanently losing your capital. Return comes second.
And really, that's what this all comes down to. The philosophy itself, as you've seen, is pretty simple. It's not complicated. Understanding it is the easy part. The real challenge, the question you have to ask yourself, is the one on your screen right now. Do you have the discipline to actually do it? To have the emotional strength to stick with it when things get crazy, when the markets are in chaos and the entire crowd is stampeding in the other direction? That is the difference between knowing the path and actually walking it. That's what makes an investor.
Welcome to The Explainer. Today, we're going to tackle a question that's really at the heart of all investing. And we're going to explore why the answer is, well, far more of an art than it is a science. Let's get right into it. This right here is the big one. How much is this thing really worth? Every investor, every analyst, they're all looking for that one number, a single, solid value that they can hang their hat on and make a decision. And look, that desire for certainty, for a black and white answer, it's completely understandable. And, we've built all these incredible tools that seem to promise us exactly that. We have spreadsheets, complex financial models that give us this almost seductive sense of precision. They spit out a number to the 5th decimal place, and you look at it and you think, okay, that's it. That's the answer. It feels solid. But that feeling of safety, it's really just a dangerous illusion. Because as the saying goes, trying to be precise in a world that is inherently imprecise only leads you to be, well, precisely wrong. A business's true value just isn't some fixed point on a map that you can pinpoint with a GPS. And here's why that precision is so misleading. It comes down to a simple concept. Garbage in, garbage out. Any financial model, I don't care how fancy it is only ever as good as the assumptions you feed into it. And when those assumptions are about the future, you're predicting sales, profits, what the economy is going to do years from now, you're really just making educated guesses. And if those guesses are off, even by a tiny bit, the final number is basically worthless. Garbage assumptions in, garbage valuation out. So, if chasing a single precise number is a trap, then what's the alternative? How are we supposed to approach valuation in a way that actually respects the uncertainty that we know is out there? Well, the legendary investor Benjamin Graham, this is the guy who taught Warren Buffett. He offered a much more practical, much more realistic way to think about it. He basically said, you don't need to know a company's exact value. You just need to know enough to say with confidence, yeah, this is a bargain, or whoa, that is way overpriced. You're looking for a reasonable range, not some single magic number. And believe me, this isn't just some abstract theory. Take a look at this. It's a real-world example from back when the department store Bloomingdale's was up for sale. The so-called experts on Wall Street, with all their fancy models, came up with valuations where the highest estimate was nearly double the lowest one. Think about that. If the pros can't even agree within a 100% range, what chance do we have of finding one single precise number? And actually, this imprecision, this difference of opinion, is the very thing that makes a stock market work in the first place. The only reason a market exists is because a buyer thinks a stock is worth more than the current price, and a seller thinks it's worth less. The transaction happens right there in that gap. It's all built on disagreement. All right, so let's get into the toolkit. To build this useful range of value, we can look at any business through 3 different, let's call them analytical lenses, and each one gives us a unique and really valuable perspective. Okay, our first lens is called net present value, or NPV for short. The big idea here is pretty straightforward. You try to project all the cash a business is probably going to generate for the rest of its life, and then you figure out what that whole future stream of money is worth in today's dollars. After all, a dollar you get a year from now is worth less than a dollar in your pocket today, right? NPV just applies that simple idea to all of a company's future profits. But here's the catch with NPV, and it's a big one. It is incredibly sensitive to your assumptions. Just look at this, a tiny 2 percentage point change in the discount rate. that's the number you use to value that future cash, causes the final valuation to swing by a massive 25%. It just goes to show you how one little tweak in your assumptions can totally change the outcome. So our second lens brings a really important dose of reality into the picture. It's called liquidation value, and it answers a very simple and honestly a kind of brutal question. If this business shut its doors for good today and we sold off all its physical stuff, the buildings, the trucks, the inventory, what would be left over after we paid off every single debt? I love this method because it acts as a powerful tether to reality. It makes you forget all the optimistic stories about future growth and just focus on the hard assets you can actually see and touch. It gives you a rock-bottom floor for a company's value. It protects you, the investor, from paying a high price for nothing more than hopes and dreams. And our third and final lens is what we call private market value. This approach asks a super practical question. Forget the stock market for a second. What would a smart, informed business person pay to buy this entire company, lock, stock, and barrel? And to get an answer, we look at what similar businesses have actually sold for in the real world. Now, while this gives us a fantastic real-world benchmark, it definitely comes with a big warning label. See, during market bubbles, think about the junk bond takeover craze in the 80s, the prices people pay for companies can get completely disconnected from reality. And if you rely on those inflated historical prices to guide you today, well, you could get yourself into a lot of trouble. Okay, so we've got our three lenses, right? Net present value, liquidation value, and private market value. Now let's put them to work and see how they can help us understand a really fascinating real-world case from back in the early 90s. So let me introduce you to ESCO Electronics. When this company was spun off from its parent, it was, to put it mildly, an absolute mess. It was losing money hand over fist, it was tangled up in these nasty legal disputes with the government, its future looked just awful. So of course, the minute investors got their hands on shares of this new company, they just dumped them. The stock price totally cratered. In this slide, this just perfectly shows the kind of opportunity that can come from that kind of extreme pessimism. The market was selling shares for around $3. But if you just took a quick peek through our second lens, liquidation value, you saw something astounding. Just its net working capital, which is a super conservative way of measuring its shutdown value, was more than $15 a share. So here's the crucial point. You didn't need a crystal ball to see the potential. You didn't have to perfectly predict its future. That $3 stock price was pricing in an absolute total disaster. It assumed the worst possible outcome. That means any outcome that was even slightly less than a complete catastrophe meant the stock was worth more. That huge gap between the pessimistic price and a conservative value, that's what investors call the margin of safety. And that is exactly how it all played out. Eventually, those legal disputes got settled, the business got its feet under it and stabilized, and as that big, dark cloud of uncertainty started to clear, the market finally began to recognize the real, tangible value that was there all along. The stock price shot up to over $8 a share, more than doubling for anyone who was willing to see value when everyone else just saw fear. So after going through all this, the pitfalls of false precision, the tools we can use to build a more rational range of value, what's the big takeaway? What does this all really mean for us as investors? I think Warren Buffett said it best. You can find the greatest company in the world with the brightest future imaginable, but if you pay too high a price for its stock, you can completely wipe out all the benefit of that company's success for the next decade. At the end of the day, it's simple. Price is what you pay and value is what you get. Getting that relationship right is everything. So it really all boils down to just a few core principles. First, accept that valuation is an art that requires your judgment. It's not a science. Seek a range of value. Use these different methods to check your work. Always be conservative in your assumptions. And maybe the most important rule of all, if you can't understand the business, you can't value it, so just stay away. Ultimately, thinking this way completely changes your goal. You stop hunting for that one magic number, and instead, you start building a solid framework for making smart decisions in a world that is always uncertain. The true art of valuation, it turns out, isn't about having all the answers. It's about knowing which questions are the right ones to be asking in the first place.
All right, today we are jumping headfirst into one of the biggest challenges and, frankly, one of the biggest opportunities for any investor: the hunt for hidden value.
We're going to take what feels like a totally overwhelming task and turn it into a structured, manageable quest.
I mean, it's a question that can just freeze you in your tracks, right? You're staring at this ocean of information. Financial statements, analyst reports, all the noise from the market. The sheer volume of it all can make just figuring out where to start feel completely impossible.
And this quote right here, it just perfectly frames our mission today. This isn't about getting lucky and stumbling upon some great idea. No, it's about a deliberate, diligent search. We're not just casually scanning the market, we are officially on a treasure hunt.
So here's our roadmap for the hunt. First, we'll tackle the fundamental problem of even searching for value. Then, we'll lay out an actual treasure map, showing you where to look. We'll dig into why these bargains even exist. After that, we'll get into the right mindset, thinking like a contrarian. And finally, we'll answer that all-important question, when do you stop digging?
Okay, first up, the search for value. This is all about focusing our energy, because, let's be honest, most of what you're going to look at is, well, it's not a special opportunity. It's just fairly priced.
Look, you could literally spend your entire life analyzing companies that are perfectly and, boringly priced. A smart investor doesn't just analyze everything. No, they first figure out which ponds are most likely to have the big fish swimming in them. It's all about efficiency and focus.
Okay, so if we need to know where to look, then we need a map. This is our treasure map. Value investing isn't a random walk in the park. It's about systematically exploring very specific, very promising territories. Our map points to three main hunting grounds. First, we're looking for companies you can buy for less than what their pieces would be worth if you broke them up. Second, we're looking for special situations where you have a pretty good idea of the return and the time frame. And third, we're diving into the opportunities that show up during big corporate shakeups. Let's drill down on that first area. This is classic value investing, right? Finding a business whose individual parts are worth more than its current stock price. Now, you can use computer screens to get a list of potential candidates, but, and this is a big but, that data is often old or just plain wrong. So you've still got to roll up your sleeves and do the hard work of verifying everything yourself.
Now, the second spot on our map is a different kind of beast. These are what we call event-driven opportunities. Think about when one company announces it's buying another. Well, you know the proposed buyout price, and you can make a good guess at the closing date. This lets you calculate a potential rate of return. And you know what? You can often find these just by reading the daily financial news.
And our third territory, this is where things can get messy. And because they're messy, they can be very, very interesting. Asset conversions happen when a company is in turmoil. We're talking bankruptcies, major debt restructurings, complex offers, the kinds of situations that scare most investors away. And that's exactly why incredible bargains can be found here.
So finding something that looks cheap is just step one. The real work, the most important question you have to ask is, why is it cheap? Because understanding the reason is what separates a brilliant investment from a total value trap.
This quote just illustrates the mindset perfectly. Think about it. If you saw a house in a great neighborhood selling for half the price of all the others, you wouldn't just run in and sign the papers. You'd ask, what's the catch? Is it sinking into the ground? Is it haunted? That healthy skepticism, that's an investor's best friend. So, when you find that cheap stock, there are really only two possibilities. It could be a value trap, a business that's cheap because it's fundamentally broken. Or it could be a market glitch, a genuine opportunity that's cheap for some temporary, non-fundamental reason. Our entire job is to figure out which is which.
So where do these glitches even come from? Well, sometimes big institutions are forced to sell a small spin-off company because it's just too small for them. Or you've got investors selling their losers at the end of the year for tax reasons, pushing prices down for no good reason. Sometimes a company is just too small or too obscure for Wall Street to even bother with. These are the cracks in the market where real value hides.
And all of this brings us to the psychological core of value investing. To find these overlooked gems, you simply cannot be doing what everyone else is doing. You have to actively, purposefully go against the crowd.
It's really just simple logic. If an investment is popular, if everyone's excited about it and piling in, guess what? The price has already been bid way up. The odds of it being a true bargain are slim to none because all that optimism is already baked into the price.
So, if the bargains aren't in the popular stocks, where are they? Well, they're in the exact opposite places. They're in the stocks that the herd is panicking out of. They're in the boring, neglected companies that no one is even talking about. They're in the obscure corners of the market that will never make the front page news.
But let me tell you, this is the hardest part. Being a contrarian is tough. When you buy something that everyone else hates, the trend that made it cheap in the first place can just keep on going. You almost certainly look wrong on paper for a while, and it takes real guts and conviction to hang on until the market finally recognizes the value that you saw.
This all leads to a really practical question. I mean, if we're doing all this digging for hidden gems, how do we know when we've dug deep enough? Can you actually do too much research?
Oh, absolutely you can. It's the 80-20 rule of research. You're typically going to gather 80% of the really critical make-or-break information in the first 20% of your time. So what should you focus on? 3 things. Is the business simple and durable? Is the balance sheet rock solid? And is management both capable and honest? Get answers to those, and you are most of the way there.
Let me tell you a cautionary tale. There was an analyst who knew literally everything about Clorox, every product line, every market share point, but he was so buried in the tiny details that he missed the big picture. He couldn't see the forest for the trees as the company's entire business started to fall apart. The stock collapsed. Knowing every detail does not guarantee success.
So, if you can't know everything, what's one of the single most powerful clues you should focus on? Just watch what the insiders are doing. Nobody, and I mean nobody, knows a business better than its own management team. And when they start buying their own company's stock on the open market with their own money, well, that is one of the strongest green lights an investor can ever get.
And that's really the key takeaway here. The goal isn't to achieve perfect knowledge or certainty. It's to find situations where the price is so low that it gives you a huge cushion, a margin of safety for all the things you don't know and can't know. In fact, high uncertainty is often the very thing that creates the low price in the first place. That uncertainty, it's your friend.
So as we wrap up, the real challenge isn't just about finding information. It's about developing the guts, the psychological strength to act with confidence in the face of ambiguity. The question isn't just, can you find the information? It's, can you pull the trigger when the picture is still incomplete? The hunt is on.
You know, when you look at the market today, it can feel like every single stock has been analyzed to death, like all the good ideas are already taken. But what if I told you that the real opportunities, the truly great ones, aren't out in the open? They're actually tucked away in the corners of the market that most investors are either too busy or, frankly, too scared to even look at.
So let's ask that question head on. Are all the great investments really discovered? Has every last bargain been snatched up? The answer is a resounding no. Not even close. The truth is, if you're willing to roll up your sleeves and look in places where other people won't, you can find some absolutely incredible opportunities. Let's start with a big problem every value investor runs into. Okay, so here's the core issue. The simple, obvious value investments, a fantastic business selling at a ridiculously steep discount, well, they get spotted almost immediately. The simpler the idea, the more obvious the bargain, the faster that price corrects. And what that means for us is that the easy money is gone in a flash. It means we've got to dig deeper to find those real, lasting opportunities.
You gotta love this classic analogy from Benjamin Graham. He called it cigar butt investing. Just picture it. You're walking down the street and you find a cigar that someone's thrown away. It looks like trash, but you realize there are still a few good puffs left in it, and they're free. It's not about finding perfect, pristine companies. It's about finding overlooked value where everybody else just sees garbage. So, let's say you find one of these undervalued stocks. How do you know its price will ever go up to reflect its true worth? You can't just sit around and hope the market wakes up one day. No, you need something more. You need a trigger. You need a catalyst. This is the key. It's the specific event that forces the market to finally see the value that you saw all along.
And let's be really clear here. A catalyst is not just wishful thinking. It is a specific, foreseeable event that's going to force that gap between the stock price and its real value to close. We're talking about things like a company being sold, a massive asset sale, or a whole business unit being spun off. By giving you a clear path to getting your money, a catalyst seriously reduces your risk. It's all about beefing up that margin of safety, that all-important cushion between the price you pay and what an asset is really worth. You're no longer just waiting and hoping.
Now, catalysts basically come in 2 main flavors. You've got total value realization, which is kind of the holy grail. That's when the entire company is sold or liquidated. It's a one-time event where all the value gets unlocked at once. But partial realization can be just as powerful. We're talking about things like massive share buybacks or spin-offs. They unlock value in stages, and just as important, they send a huge signal that management cares about shareholders, which might just mean more good things are on the way.
And that brings us right to our first hunting ground, what I like to call corporate discards. These are situations like liquidations and spin-offs where a company is literally throwing away assets. Now, most investors see this and they run for the hills. They see complexity, they see uncertainty. But for us, this is exactly where the map to hidden treasure begins.
All right, let me walk you through a fantastic real-world example. Back in 1984, there was this big conglomerate called Citi Investing Company, and it decided to liquidate itself. So after spinning off its main insurance business, all the leftover assets were thrown into this thing called the Citi Investing Liquidating Trust. Now, this was exactly the kind of messy, complicated situation that most investors avoid like the plague, and that is precisely why it became such a golden opportunity. And just look at what was left over. This was not a clean, simple business. I mean, it was a total hodgepodge. You had cash, some real estate, a bunch of mortgages, and even a stake in a private company called Pace Industries. To figure out what this thing was actually worth, you had to be part accountant, part real estate guru, part private investigator. Most investors took one look at this list and all they saw was a massive headache. They just moved on.
So why did it get so cheap? Well, it was a perfect storm of factors that had almost nothing to do with the real value of the assets. First, you had the original investors who were just fed up and dumped their shares for any price. Then, the new share price was so low that big institutions were forced to sell because it fell below their own rules. Then, it got delisted from the New York Stock Exchange, it had no ticker symbol, it became almost impossible for anyone to even track. And the cherry on top, there was a hidden gem inside, that investment in Pace Industries, which was worth way more than what it said on the books.
And here is the payoff. This is the beautiful part. The few investors who were willing to wade through all that complexity, who ignored all the noise, they bought in at around $3 a unit. And over the next couple of years, they got distributions from the liquidation that totaled about $9. That is a threefold return, simply by being willing to buy the thing that everyone else was literally throwing away. It's just a brilliant example of finding treasure in the trash. Now, that exact same discard principle applies to our next big opportunity, the corporate spinoff. This is when a big parent company basically gives its shareholders some shares in a smaller subsidiary, creating a brand new independent company. And just like with liquidations, these shiny new companies often get tossed right in the trash by their new owners, creating another fantastic hunting ground for us.
Okay, let's break down exactly how this works because it's like clockwork. Imagine a massive billion-dollar fund. They own a big chunk of some giant parent company. When the spinoff happens, they suddenly get handed this tiny little position in a new, much smaller company. For them, it's a rounding error. It is way too small for them to bother analyzing or managing. So what do? They sell. They just dump the shares immediately without a second thought about the price or the company's value. And this forced, indiscriminate selling creates a tidal wave of supply that just crushes the stock price, creating a temporary bargain for anyone who's paying attention. So here's the crucial point. This selling pressure is structural, not fundamental. It's not happening because the spinoff is a bad business. No, it's happening for all these other mechanical reasons. The original shareholders don't understand it. Index funds sell it automatically if it's not in their specific index. Wall Street analysts, they don't cover it yet. And even the data services can be months behind. Essentially, it's a company that's born into this vacuum of information and interest, which is the absolute perfect environment for a value investor to find a deal.
All right, our next uncharted territory isn't a type of company, but actually a type of security. Sometimes an investment is cheap for one simple reason. It's just too complicated for most people to figure out. And when an investment doesn't fit into a neat little box, it often gets completely ignored and, you guessed it, mispriced. So what are we talking about here? Well, these are investments where the payout you get depends on some future event, like a company hitting a certain earnings target or a new drug getting FDA approval. They aren't simple stocks or bonds. Because they're so unique, often one of a kind, they just fall through the cracks. Most of the standard financial models can't handle them, and most investors won't even bother trying to figure them out. And that creates a very fertile ground for bargains. Let me give you a fascinating example. When Dow Chemical acquired part of Marion Labs, they issued this weird thing called a contingent value right. Just think of it like an insurance policy for shareholders. Dow basically promised that the stock of the new company would be worth a certain amount by a specific date in the future. And if it wasn't, Dow would pay them the difference. up to a certain limit. It was so unusual, so bizarre, that almost no one knew how to value it, and all that complexity scared investors away, creating very little demand and therefore a huge opportunity for undervaluation. Now for the final piece of the puzzle. It is absolutely crucial to understand that these pockets of opportunity, whether we're talking about spin-offs or these complex securities, they aren't static. They don't last forever. In fact, they follow a very predictable cycle. A niche that's incredibly profitable today might become completely overcrowded tomorrow, only to become a fantastic opportunity again once the crowd has moved on. And this cycle is so predictable. It always starts in phase 1, when a strategy is unpopular. Only a few specialists are in on it, and the returns are fantastic. Well, those high returns attract a crowd in phase 2. All this new money comes pouring in, bidding up prices and, of course, lowering future returns. This leads directly to phase 3, disappointment. The hot money gets burned and flees, forcing sales and pushing prices way down. And all that forced selling creates the fresh bargains that set the stage for phase 4, when the niche is unpopular all over again, and the cycle of high returns can begin for the patient investors who stuck around. A perfect, real-world example of this cycle is risk arbitrage. That's investing in companies that are being acquired. In the early 80s, very few people did it, and the returns were great. By the late 80s, everybody and their brother had piled in. All that competition meant the potential profit on each deal got smaller and smaller. Then, in 1990, a few big deals blew up, everyone got scared and ran for the exits. And then suddenly, for the few investors who remained, the opportunities became incredibly attractive all over again. Understanding the cycle is what tells you when to be greedy and when to be fearful. Okay, so let's bring this all together. Here's the most important takeaway from all of this. These incredible pockets of value, they don't just exist by accident. They persist for very specific reasons. They're protected by these deep moats of complexity, of obscurity, and by institutional rules that keep the vast majority of investors on the sidelines. The opportunities are there, they are real, and they are waiting for the handful of people who are both able and willing to do the hard work. So we've looked at corporate discards, complex securities, and the inevitable cycles of investment fashion. These are the uncharted territories on the true value investor's map. The opportunities are out there, waiting for those who are willing to go hunting for them. So the map is in your hands. The only question left is, which territory will you explore first?
All right, let's jump right in. We're going to explore a really fascinating and, mostly forgotten corner of the investment world. We're talking about a specific kind of event that, for a little while, let the sharpest investors tap into a powerful quirk in the financial system. It's a great story about crisis, opportunity, and some very unusual math. Now, just let that sink in for a second. Imagine an investment where you put in your dollar, and in return, you get your dollar back plus the entire existing value of the company for free. It sounds completely crazy, right? Almost too good to be true. But for a time back in the 80s and 90s, this was a reality thanks to something called a thrift conversion. So how on earth did this even work? To really get our heads around this incredible opportunity, we have to take it step by step. First, we'll look at the sleepy world of banking before all the chaos started. Then we'll see how a major crisis created this one-of-a-kind opening. We'll break down the secret math that made it all tick, see why you were literally investing on the same team as the insiders, walk through a fantastic real-world case study, and then, at the end, pull out the timeless lesson this holds for all of us as investors today.
Okay, let's set the stage. To really appreciate the opportunity that came later, you first have to understand the quiet, predictable industry that was about to get completely turned on its head. This was the world of your local thrift, the savings and loan. It was a cornerstone of Main Street America for generations.
There was this old joke that perfectly sums up the business model. It was simple, it was profitable, and man, was it stable. Thrifts would take in savings from folks in the community at a low interest rate. Then they'd lend that money back out as long-term home mortgages at a higher rate. That difference, that spread, that was their profit. For decades, it was just a comfortable, pretty low-risk way to make a living. But that sleepy, stable world just couldn't last forever. A whole series of regulatory changes in the late 70s and early 80s just shattered that 363 model. It created a massive crisis that, funny enough, paved the way for the hidden opportunity we're talking about.
And you can just see the dominoes fall, right? First, deregulation hits. Now thrifts have to compete for deposits, which means offering higher interest rates. The problem? Their income is still locked up in all those old low-rate mortgages. So when market interest rates went through the roof, their cost of money was suddenly higher than what they were earning. They were literally bleeding cash. To try and survive, many of them were allowed to chase much riskier loans, which, just made things worse, leading to huge losses and a desperate industry-wide scramble for new capital.
So, for the handful of healthy, well-run thrifts out there was a solution. They could raise the capital they needed by converting from their old mutual ownership structure, where they were sort of owned by their depositors, to a stock company owned by shareholders. This process, this thrift conversion, had a totally unique and incredibly favorable kind of math that you just don't see in any other IPO.
Okay, this slide right here is where the magic happens. Look at the difference. In a normal IPO, the company's existing value is already owned by somebody, the founders, the venture capitalists. When you, the public investor, buy new shares, your money actually waters down the book value for everyone. But in a thrift conversion, there were no prior shareholders. The thrift had, say, $10 million of net worth just sitting there, unowned. So when the public came in and invested another $10 million, both pots of money were just combined, and the entire $20 million was given to the new shareholders. Think about that. You put in $10 per share, and your share instantly had a claim on $20 of assets. You essentially doubled your investment's underlying value on day one.
So this is the absolute key to the whole thing, this powerful mechanism. The money you invested wasn't just buying a piece of the business. It was being added to the capital that was already there. And that existing capital, built up over decades, was effectively handed to you, the new investor, completely free of charge. This is the secret at the heart of this entire opportunity.
But the magic didn't actually stop with just the math. There was another piece to this puzzle that made these investments uniquely compelling and, frankly, transparent in a way you just didn't see from a typical Wall Street deal.
And this is so important. In most IPOs, you have no clue what the founders and the early investors paid for their stock. It's usually pennies on the dollar compared to what you're paying. But in a thrift conversion, the prospectus spelled it all out for you. You could see exactly how many shares the CEO and the board of directors were buying with their own money at the very same price you were being offered. You could literally invest shoulder to shoulder with the people running the show.
All right, let's see how all these pieces came together in a real-world example. It's a perfect one. We're going to look at the Jamaica Savings Bank, or JSB. They decided to do their conversion right in the middle of a raging financial storm, when fear was just at its absolute peak.
I mean, you couldn't have picked a worse time, or so it seemed. The entire thrift industry was just toxic. The headlines were filled with stories of bankruptcies and bailouts, the market was in a total panic, and basically anything with the word thrift or savings in the name was being sold off like it was radioactive. And right into this mess, JSB decides to try and go public.
And this table just shows it all. It explains why JSB was completely different from all the institutions that were collapsing around it. While the other thrifts were barely capitalized and loaded up with garbage loans, JSB was a fortress. It had one of the highest capital ratios in the entire country, and 2/3 of its assets were in ultra-safe stuff like cash and treasury bonds. It was the furthest thing from a troubled thrift, but because of the market panic, it was being offered at this incredible discount, just 47 cents for every dollar of its real tangible value.
And what's even better, management had a really simple, powerful plan to unlock all that value. They were going to take half the money they raised from the public and just keep it as cash. Then they announced right in the prospectus their plan to use that cash to aggressively buy back their own stock in the open market. And look, buying back your own stock for less than it's worth is a fantastic way to make the remaining shares more valuable. And to top it all off, the insiders showed they believed in the plan by buying a ton of stock for themselves in the offering.
So, what was the result? It was immediate. On the very first day of trading, JSB's stock jumped 30% above its offering price. Even as the rest of the market was falling apart, the sheer, undeniable value of this business just couldn't be ignored. The market woke up and realized, hey, this is not just another one of those troubled drifts.
Now, the specific opportunity in thrift conversions, well, that's largely a thing of the past. But this story holds such a powerful and timeless lesson that's every bit as relevant today as it was back in 1990. So what's the big takeaway from this fascinating piece of financial history?
And the essential lesson is really this. Markets panic. Fear and greed cause investors to just sell everything in a certain industry without even looking at the details. You know the saying, they throw the baby out with the bathwater. But for people who can think for themselves, this is where the greatest opportunities are born. By looking for those high-quality, bulletproof businesses like Jamaica Savings Bank, they get unfairly punished just because their neighbors are in trouble.
This whole history is just a great reminder that true value is often found where nobody else is looking, or frankly where they're too afraid to look. The principles of demanding a margin of safety, of analyzing a business on its own merits, and thinking independently from the crowd, that's what truly builds wealth over the long run. And that leaves us with a final question to chew on. What babies are being thrown out with the bathwater in today's market?
You know, what if I told you that one of the best investments you could possibly make is in a company that's teetering on the edge of collapse? Yeah, it sounds completely insane, I know. But today, we're going to dive into a world where bad news is actually good news, and where fortunes are made by having the guts to see value where everyone else just sees failure. This is the art of distressed investing. I mean, think about it. It's a totally counterintuitive idea, right? When you see a company on the news for all the wrong reasons, debt is piling up, profits are gone, bankruptcy is looming, your gut, my gut, everyone's gut tells us to run for the hills. But for a very specific, very sharp group of investors, that's not a red flag. That's the starting gun. They understand that the moment of maximum panic is almost always the moment of maximum opportunity.
We've all got this image of bankruptcy burned into our brains, probably from the movies, right? A total collapse. A factory with a padlock on the gate, lights off, everybody's gone home. But the reality? Well, the reality is usually far, far more strategic. For a lot of these companies, bankruptcy isn't the end of the story. It's a tool. It's a chance to hit the reset button, protected from their creditors, and reorganize into something leaner, meaner, and more competitive. And understanding that one difference is everything. So, here's the game plan for how we're going to break this all down. First, we're going to unpack that stigma of distress and see exactly why it creates value. Then, we'll step into the shoes of a struggling company and look at the tough choices it has to make. We'll take a peek inside the world of Chapter 11, we'll crack open the investor's playbook, and finally, we'll weigh the massive risks against those potential rewards. All right, let's get into it.
Okay, this first part really gets to the heart of the whole thing. The opportunity in distressed investing exists for one simple reason. Most people, most investors, just can't see past the bad news label. That stigma creates this huge wave of panic selling, often at any price just to get out. And that panic is what creates the very bargains we're here to understand.
So when we say distressed security, what are we actually talking about? Well, just like the slide says, these are the stocks and, more often than not, the bonds of companies that are in some seriously hot water financially. They are trading for way, way below their par or face value, sometimes for just pennies on the dollar. The billion-dollar question for an investor is this: are they really just worth pennies, or is there some hidden value that the panicked market is completely missing?
So why does this opportunity even exist? I mean, if it's so great, why isn't everybody doing it? Well, because it's hard, really hard. The analysis you have to do is incredibly complex, way beyond your typical stock research. The securities themselves are often illiquid, which means they can be tough to buy and sell. The legal process can be a total slog. And then there's just that simple stigma of failure. You might have to dig through dozens of these situations just to find one good idea. But here's the key. That huge barrier to entry is precisely what creates the opportunity.
Now, let's flip the script for a minute. Let's look at this whole thing from the company's perspective. When a business is in deep trouble, it's standing at a fork in the road. It faces a critical choice between three potential paths, and none of them are easy.
So, door number one is to just try and tough it out. Cut costs, sell off some assets, do whatever it takes to stay afloat without having to go to court. If that's not going to cut it, they can try door number two, an exchange offer. This is where they go to their bondholders and ask them to voluntarily swap their old bonds for new ones with more manageable terms. And if that fails, well, then there's door number three, the last resort, file for Chapter 11 bankruptcy protection. Now, that second option, the exchange offer, sounds pretty good in theory, right? But it hits this massive roadblock, and it's called the free rider problem. Put yourself in the shoes of a bondholder for a second. The company comes to you and asks you to take a haircut, basically accept less than you're owed to help it survive. You might want to do it, but then you think, what if the other bondholders refuse? They get the benefit of my sacrifice while they still get to demand being paid in full. It creates this classic standoff. And what this standoff creates is a textbook prisoner's dilemma. You've probably heard of it from game theory. It's one of those situations where the rational choice for each individual person leads to a terrible outcome for the group as a whole. Just look at this table. It lays out the dilemma perfectly. If you exchange your bonds and everybody else does too,
Great, the company might survive. That's a good outcome. But if you exchange and the other guys hold out, you lose while they win. So your best personal strategy is to hold out while hoping everyone else is a good Samaritan and exchanges. But here's the catch. Every single bondholder is making that exact same calculation. So what happens? They all hold out. The exchange fails and the company goes bankrupt. A bad outcome for everybody.
So how do you solve this impossible dilemma? Well, with a pretty ingenious solution called a prepackaged bankruptcy. Here's how it works. The company and the vast majority of its creditors get together and negotiate a full reorganization plan before they ever set foot in a courtroom. Then, they briefly file for bankruptcy, not to fight it out, but simply to use the court's legal power to force those few holdouts to accept the deal. It's really the best of both worlds. You get the speed of a private negotiation with the legal muscle of a court order.
And this brings us right to the bankruptcy process itself. And like we've been saying, Chapter 11 isn't a white flag of surrender, not at all. When it's used the right way, it is an incredibly powerful strategic tool for completely transforming a business.
Bankruptcy has been called a salutary catharsis, which is just a fancy way of saying a healthy cleansing. The moment a company files, bam, something called an automatic stay kicks in. It freezes all creditor lawsuits and collection efforts. It's like a legal timeout. And suddenly, the company has these incredible powers. It can tear up expensive real estate leases, it can get out of bad contracts, it can shed all sorts of legacy costs. And by doing all this, it can emerge from bankruptcy as a brand new, lean, low-cost competitor.
Now, here's a fascinating dynamic that happens inside bankruptcy. Remember, the company stops paying interest on all its old debt. At the same time, it's busy cutting costs and maybe selling off some assets. What's the result? It starts to build up this massive pile of cash. This has led to what one advisor calls the money market theory of bankruptcy. And the idea is actually really simple. As that pile of cash gets bigger and bigger, it becomes way easier to get everyone to agree on a plan. Why? Well, because cash solves a lot of problems. You can just use it to pay people off and get the deal done.
Okay, so we've seen the whole journey from the company's side. Now let's put on our investor hat. If you think of a bankrupt company as a big pie, the investor really only has two fundamental jobs. First, figure out how big that pie actually is, and second, figure out exactly how it's going to be sliced up. It really all comes down to these two core tasks. That's it. First, you have to value the business itself. What are its assets really worth? That's the true size of the pie. Second, you have to analyze all the liabilities, all the debts. This tells you the legal pecking order for who gets a slice of the pie and in what order they get served.
And this is that pecking order. Legally, it's known as the absolute priority rule. Right at the very top, you have the secured creditors. Think of a bank that has a mortgage on a factory. They get the first slice, period. Then come the unsecured bondholders, from senior down to junior. And only after every single one of those people has been paid in full do the stockholders get anything. This is so important. In most bankruptcies, the common stock, the very last in line, gets nothing, wiped out, zero.
The legendary investor Michael Price actually broke down this whole process into three distinct stages. Stage 1, right after the company files, is the Wild West. It's pure chaos, fear is through the roof, information is scarce, and big institutions are often forced to sell their holdings, creating huge bargains. In Stage 2, the negotiation phase, the fog starts to lift a bit, but the final outcome is still up in the air. By Stage 3, the plan is locked in. The risk is much lower, and the investment starts to look a lot more like a predictable arbitrage trade.
Now, it is really easy to hear all this stuff about opportunity and get excited. But this final section is a critical reality check. Distressed investing is a high-stakes game. Mistakes aren't just costly. They can be absolutely catastrophic. Caution is everything here.
In this case study of the Bank of New England shows you just how completely irrational and broken markets can get. Just look at these numbers. The company's bonds, which get paid back first, had a total market value of less than $100 million. Okay, at the very same time, the common stock, which remember gets paid last and only after the bonds are paid in full, had a market value of $250 million. Let that sink in. The market was valuing the claim that gets paid last at 2.5 times the claim that gets paid first. It makes absolutely no logical sense.
And the reason for this absurdity is captured perfectly in this quote. It's as if the stock investors and the bond investors weren't even talking to each other. These crazy dislocations happen because different markets are driven by different people with different rules and, frankly, different emotions.
For a savvy investor, though, this created a crystal clear trade. You buy the cheap senior bonds and you sell short the insanely overpriced junior stock, betting that its price would eventually crater.
But these kinds of opportunities come with massive risks. Timing is critical. A bankruptcy that drags on for years and years can just eat away your returns. The market is illiquid, which means the prices you see quoted can be misleading, and it's very easy to overpay. And if you bet on those junior securities like the common stock, you can be, and often are, completely wiped out. The complexity is just immense, and you have to get a whole lot of things right just to have a chance to win.
And that really brings us to our final thought. At the end of the day, this isn't just about spreadsheets and legal documents. It's about psychology. It's about having the nerve to step in when everyone else is sprinting for the exit. It's about having the discipline to do painstaking analysis right in the middle of a hurricane of chaos. And it's about having the vision to see a clear path to recovery where others just see that padlocked factory gate. It is a very difficult art for sure, but it's a powerful reminder that in investing, sometimes the best news is hidden inside the very worst headlines.
All right, welcome to The Explainer. You know, we all love the excitement of finding that one great stock, right? But today, we're going to move past that. We're going to talk about the real work, the crucial ongoing discipline of managing an entire investment portfolio. Because let's be honest, that's where long-term success is actually forged.
Okay, so here's what we've got on tap. First, we'll talk about investing as a never-ending journey. Then, we'll get into the balancing act of liquidity. After that, we'll cover some smarter ways to reduce risk, the art of buying and selling, and finally, we'll pull it all together into the right mindset. Let's dive in.
First up, investing's endless journey. And this is a big one. We've got to start with a shift in perspective that honestly changes everything. See, most people think of investing like a project. You know, it has a start, it has a finish, but the reality, well, it's something totally different. It's an endless journey.
Right. I mean, think about it. A project has a clear finish line, doesn't it? You complete it, you move on. Portfolio management, it goes on forever. There is no finish line. It's this continuous loop of reviewing, adjusting, and making decisions. It's not some checklist you can just tick off and be done with. And this slide just nails the point. So, you've got a business, say Heinz. Super predictable, right? They sell a ton of ketchup year in, year out. It's like clockwork. But does that mean your return as an investor is just as predictable? Absolutely not. No guarantee at all. Why? Because everything, and I mean everything, depends on the price you paid for that stock. Okay, Section 2, the Liquidity Balancing Act. Now, if the price you pay is that important, it stands to reason you need the flexibility to act when you see a good price, right? And that leads us to one of the most underrated and frankly misunderstood concepts in all of investing: liquidity. Think of it as your financial escape hatch. So let's start with a simple question. Since none of us are infallible, what's the price of being able to change your mind? I mean, seriously, think about that. We all make mistakes. Circumstances change. The ability to say, you know what, I was wrong, and sell an investment, that has incredible value. If you don't have that ability, you are completely locked in. And believe me, that comes with a very real cost. So what are we talking about when we say liquidity? It's really simple. It's just the ability to turn an investment into cash quickly without crashing its price in the process. It is your financial flexibility. It's all about having options when you absolutely need them. And you have to think about this on a spectrum, right? On one end, you got something with crazy high liquidity, like a stock like IBM. You can sell it anytime, no problem, with only minor financial consequences. But on the other end of the spectrum, something highly illiquid, like a private company, you could be totally stuck, locked in, and able to change your mind at any price. That's a scary place to be. But here's the thing about liquidity. There are a few truths you've got to know. First, it can be a total illusion. I mean, it seems to be everywhere until there's a panic, and then, poof, it's gone, right when you need it most. Second, it's often tied to what's popular or faddish at the moment. So the big takeaway here is that most portfolios need a balance. You don't want to be too liquid, but you definitely don't want to be too illiquid either. All right, Section 3, smarter ways to reduce risk. So liquidity gives you options, it gives you flexibility. But what about managing the risks inside the portfolio itself? This is where we go beyond just picking good stocks and start thinking about protecting the whole ship. And for that, we have two really powerful tools. Yeah, See, portfolio management is how you reduce risk even further. It's not enough to just pick a few good stocks. You could have a portfolio full of what you think are winners, but your job is nowhere near done. You have to think about how they all play together as a team. And the two main ways we do that? Diversification and hedging. Okay, so let's talk diversification. And this number might actually surprise you. A lot of people think you need hundreds of stocks to be diversified. The truth? For most people, somewhere between 10 and 15 different holdings is usually enough for what we'd call prudent diversification. Any more than that, and the benefits really start to drop off. But, and this is a big but, you have to be careful not to fall into the over-diversification trap. It's like a Trojan horse. You think you're safe because you own a little bit of everything. But what's really happening? You're substituting real knowledge and analysis with just, well, owning a bunch of stuff. You end up knowing only a little about your many holdings, and that's a dangerous game. Okay, so what about that other tool, hedging? Well, it's a strategy to limit market risk. That's the risk that the entire market could decline. Think of it like this. Diversification is about not putting all your eggs in one basket. Hedging is like buying insurance, an umbrella that protects all of your baskets from a big storm. And here are a few examples of how that works in practice. A hedge has to be tailored to your specific risk. So if your portfolio is full of large-cap stocks, you could hedge by selling S&P 500 index futures. If you've got a lot of stocks that are sensitive to interest rates, you could sell interest rate futures. You get the idea. It's all about creating an opposite position that cancels out some of that specific risk. Okay, on to Section 4, the art of buying and selling. This is where the rubber meets the road, right? This is the most active part of managing a portfolio. But I want to be clear. This isn't about day trading or frantic clicking. It's about discipline. It's about intelligent execution. And it all comes down to this one quote. Investment opportunity is a function of price. For a true value investor, this is it. This is the North Star. Your decisions have nothing to do with market chatter, what's hot on TV, or some exciting story. They are driven by one thing, and only one thing. Price relative to the underlying value of the business. Everything else is just noise. So when it comes to buying, here's a smart way to think about it. Average down. What does that mean? It means don't go all in at once. Step 1, you buy a partial position, just a piece of what you ultimately want to own. Step 2, you keep some buying power in reserve. Then, step 3, if the price drops, and let's face it, it often does, you don't panic. You see it as an opportunity to buy more, lowering your average cost. It's a much more patient approach. Now, let's talk about selling, because this is where so many people get it wrong. To deal with the uncertainty, we come up with these totally arbitrary rules to avoid. You know the ones, selling based on a certain PE multiple, or after it's gone up by a fixed percentage, or maybe you set a price target the day you buy it. The problem is, all these rules are, well, they're kind of useless. They ignore the one thing that actually matters. So what is the one valid rule for selling? It's this. All investments are for sale at the right price, based on underlying business value. It's about opportunity cost. You should only sell something when you've found a demonstrably better place to put that money. That's it. That's the whole game. And that's why a strategy to automatically sell when a price drops, well, as the quote says, is in fact crazy. We're talking about stop-loss orders here. Just think about what they do. They force you to sell an investment after it's already gone down in price. It's a built-in mechanism to sell low. You're literally outsourcing your decision-making to the market's fear. It's the polar opposite of what we've been talking about. Okay, our last section, the investor's mindset. Let's pull all of these threads together now. We're going to wrap this all up into a powerful, continuous way of thinking that should guide how you manage your portfolio every single day. And look at this, the portfolio liquidity cycle. This brings us full circle, right back to that idea of an endless journey. You start with cash, that's your liquidity. You convert that cash into less liquid investments, hoping for a return. As those investments mature or get sold, they turn back into cash. And then the cycle starts all over again. It's a beautiful thing because it forces you to be disciplined, to constantly be on the lookout for the best new values. And that brings us to the final, and maybe the most important question of all. If you haven't bought something based on its underlying value, how on earth do you decide when to sell it? Think about it. If you don't have that anchor, what are you basing your decisions on? Emotion, a gut feeling, what the market is doing that day? Without value as your guide, you're just guessing, and that is a very tough way to invest. All right, let's talk about something that really affects just about all of us who have managed to save a bit of money. You've worked your tail off for it, but let's be honest, you probably don't have the time to manage it like a full-time pro. So who do you actually trust with it? That's the big question. And today, we're going to break down a really practical guide to help you make that incredibly important decision.
So let's just start with a healthy dose of reality right off the bat. This quote, it really sets the stage perfectly. We're not here to talk about some get-rich-quick scheme or guaranteed slam dunks. The hard truth is that for most of us, there just aren't a lot of easy, attractive alternatives out there. This whole explainer is about giving you the tools to navigate that tough reality with your eyes wide open.
And this right here, this is the absolute core of the problem. You see, to actually be successful over the long haul, investing isn't some hobby you can pick up on weekends. It is a serious, full-time commitment. With a flood of information coming at you 24/7 and the sheer complexity of the markets, a part-time effort, well, it just isn't going to cut it. And that's the dilemma every busy person has to face.
Which brings us right to our central challenge, what we're calling the investor's dilemma. If you can't be your own full-time portfolio manager, what are your real options? So let's walk through the path the source material lays out for us.
When you boil it all down, it pretty much comes to these three choices. You can go with mutual funds, which is what most people do. You can hire what's called a discretionary stockbroker, or you can find a dedicated money manager. Each one of these paths has its own promises, and believe me, its own perils. So we're going to dig into each one, starting with the most popular of the bunch. First up, mutual funds. On paper, they look like the perfect solution, right? You get professional management, diversification, it's easy to get in and out, but in practice, the reality is often very, very different. The source material argues that most funds, frankly, just do a mediocre job, and it is absolutely critical that you understand why. Now, it helps to know there are two main flavors. The ones you hear about most are open-end funds. You can buy or sell them pretty much any time, and their price is tied directly to the value of all the stocks they hold. That's the net asset value. But then you have closed-end funds. They have a fixed number of shares that trade on the stock market, just like Apple or Google. And because of that, their price can sometimes be way higher or lower than the assets they actually own. Now, that can create an opportunity every now and then, but for most people, the open-end structure is just a lot more straightforward. Okay, so why do so many of these funds just fail to deliver? Well, the key thing to get is that their business model creates this massive conflict of interest. See, their fees are almost always based on the amount of money they manage, not on the results they actually get for you. This gives them a huge incentive to just gather as many assets as they can. And that leads to chasing short-term fads, creating trendy funds just to attract new cash. And the worst part, when people panic and want their money back, the fund can be forced to sell its best companies at the worst possible time just to pay everyone out. It's a broken system.
So if mutual funds can be a trap, what's next? This brings us to a much more personal, much more intensive kind of search. You're not just picking a product off the shelf anymore. Think of it like this. You're hiring a CEO for your family's finances. You're looking for a true fiduciary.
This word, fiduciary, this should be the absolute standard you demand. A real fiduciary has a legal and an ethical duty to act in your best interest. Full stop. It's not about their commission. It's not about their firm's bottom line. It's about prudence. It's about integrity. This is the bedrock of the trust you're searching for. Okay, so how in the world do you find somebody like that? Look, it's not easy, but it's also not impossible. The key is to have a strict, repeatable framework for how you evaluate them. Think of it as a scorecard you can bring with you to vet any potential money manager or broker you sit down with. And here it is. This is your roadmap for that evaluation. Before you even think about handing over a single dollar, you have got to dig into these 4 areas. We're going to break down exactly how you investigate their personal ethics, their fairness to every single client, their size and capacity to perform, and maybe most importantly, the investment philosophy that guides every single decision they make. This is it. If you only remember one question from this entire explainer, make it this one. It is the ultimate acid test of a manager's conviction. Do they invest their own money and their family's money right alongside their clients in the exact same way? If they really truly believe in their own strategy, the answer should be a loud and clear yes. If not, what they're telling you is that they'd rather eat out. So, building on that, the first 2 parts of our scorecard are all about integrity. Beyond eating their own cooking, you need to know, are all clients treated the same?
When they buy a stock, does everybody get the same price at the same time, or do some bigger, more favored clients get a better deal? These are tough, direct, non-negotiable questions you have to ask. Next up, size and philosophy. You know, a great manager can actually become a victim of their own success if their fund gets too big to maneuver, and you must understand their strategy. Are they focused on absolute returns, meaning their number one job is to not lose your money, or are they just trying to beat a market index by a little bit, which is called relative performance? A huge tell is whether they have the freedom to hold cash when there's nothing good to buy, or if they're forced by some internal rule to always be fully invested, even in a crazy overvalued market. So let's say a manager passes the character test. Now you've got to look at their results. But just looking at a big, shiny return number is one of the biggest mistakes you can make. I mean, the laws of probability say that anyone can get lucky for a little while. Your job is to dig deeper and figure out if their success came from a repeatable skill or if they just got a lucky roll of the dice. This slide here gives you the forensic clues. What you want to see in a skilled manager's record is a series of steady base hits, not just one or two lottery ticket home runs. A huge green flag is seeing that they held cash and protected people's money during market downturns. On the other hand, a massive red flag is the use of leverage, that's borrowed money to juice up their returns. You're looking for a consistent strategy that's worked through good times and bad, not just some amazing performance during a bull market that they've conveniently cherry-picked to show you. So here's your final checklist for looking at performance. First, how long is the record? And this one is critical. Was it earned by the same person who's going to be managing your money? How they did in a down market is often way more revealing than how they did in an up market. Was the journey smooth, or was it a stomach-churning roller coaster? And finally, has success made them change the very strategy that made them successful? These are the questions that separate the real pros from the pretenders. And this brings us to the final test, and it's one that people often overlook. After all the spreadsheets and all the tough questions, you have to look at the human element. Do you actually click with this person? Do you feel comfortable with their style and their approach? Because if you're a conservative investor and you hire a super aggressive manager, that relationship is doomed to fail, no matter how great their track record is. It just won't work. All right, we have walked through the hidden traps of the mutual fund world, and we've laid out a pretty detailed scorecard for finding a true professional. We've talked ethics, we've talked philosophy, and we've talked performance. So now, it is time to bring this all home for your final decision. And when it comes right down to it, you really have these two valid paths. Notice that there is no magical, easy third option. You either commit the serious time and energy it takes to become a skilled investor yourself, or you commit to the serious work of using this framework to go out and find a professional you can actually trust. Both paths demand a real commitment from you. And I just want to leave you with this one last powerful thought. Doing nothing, feeling overwhelmed by all this and just leaving your money sitting there without a real plan, that is a choice. Inertia is a decision by default, and it is almost never the best one for your financial future. So, the final question, it's really for you. You've spent years, maybe decades, working for your money. It's not something to be taken lightly. Now that you're armed with this framework, what will your decision be? The power to choose that path is entirely in your hands.